Okay. Okay. Good morning, everyone. This is our last day of discussion on share-based payments, that is in AS 102. In the previous class, we discussed what do we mean by share-based payments. We discussed the definitions regarding what is a share-based payment, what is a share-based arrangement, what is necessary in how do we do the accounting treatment for an equity settled share based payment plan. We saw a couple of questions relating to that. We also discussed definitions regarding fair value, explanation of the concepts of vesting conditions, which could be a service condition or a performance condition. Today we will be doing a lot of concepts, many of which you would already be aware of from your intermediate. So I will be a little fast wherever it is new, it is old, but where it is new, I will try to keep it, try to keep the pace normal so that we can understand. Okay, so with this background, let us come back to our discussion. In the last class, we had closed by explaining about cash settled share based payments, where which are known popularly as SARs. Okay, good morning, Principia. So these are known as SARs. So this is a payment which will be made by the entity to the counterparty, which is providing goods and services, goods and or services to the reporting entity. And this payment will be made in cash. Because this payment will be made in cash, it is a financial liability. Sir, cash hai to how it will be share based payment? It will be because the payment to be made is determined on the price or value of the equity shares of the entity, and that is why it becomes a share based payment. The standard is not equity payments in equity shares. The standard is payments based on shares. It could be either actual issue of shares or it could be cash payment, but which is based on the price of the shares. So now we saw that when we did equity settled share based payments, that is ESOPs, that point of time we saw that ESOPs cannot be measured. Again, you will carry on the entire accounting depending on the fair value at the grant date. What is the fair value? Fair value is the value which is determined when the agreement is entered into and the parties to the agreement have a shared understanding of the terms and conditions. So now the important thing is, on that particular grant date, the fair value is determined. So how do we determine fair value? We determine by option pricing models. It could be a Black-Scholes model. It could be a binomial model. It could be any such model. Okay. So basis that you determine the fair value. And in the case of equity settled SBP, there is no remeasurement subsequently. Okay. No remeasurement subsequently. However, in the case of cash settled, this is a liability. This is a financial liability. So the credit will not go to SBP reserve in the case of SARs. The credit will go to SBP liability. And thereafter, it has to be remeasured every reporting period. And at the end of every reporting period, you will be remeasured. So that is the reason why for a SAR question, you will be needing the fair values at the end of each reporting period, which will be provided in the question. Okay. In the case of equity settled plans, you will not be given the fair values, or even if you are given the fair values, you will have to ignore them. Why? Because equity settled plans cannot be remeasured. Why they cannot be measured? Because it would tantamount to measuring my own equity, remeasuring my own equity, which is not permitted under accounting principles. So with this background, I think we did one or two questions on ESOPs. Let us now pick up a couple of questions on SAR so that you can understand the difference. Okay. So can you please explain the cash and equity alternative pricing? When could be taken the price for cash settlement? We'll do that later on. Okay, Sairam, we'll do it towards the later part of this session. Okay. So with this, let us please take a question on stock appreciation rights or share appreciation rights. All right. So this is picked up from your study module, which is illustration 2. And important point is similar question was there in your May exam for 10 marks. So you pick up this question and do it. It will be done. I mean, you are guaranteed marks in the exam. Most of the questions are quite similar fashioned. Okay. So XYZ issued 10,000 share appreciation rights that vest immediately. So there is no vesting period. The moment I have issued the SARs, they are vesting immediately. That means the employee benefit expense, there is no need to prorate it. There is no need to prorate it. Okay. Sorry. Vest immediately means this is options, or what you can say, SARs. Okay, this is SARs given for service already rendered. Hence, no service condition. Okay. So entire EBE has to be booked right now. Okay. Using an option pricing model at that date means the grant date, that is 1st April 20x0. At that date, it is estimated that the fair value of an appreciation right is rupees 95. SAR can be exercised at any time up to 31st March 20x3. So basically, we are starting from the exercise period itself. Okay, because there is no vesting period. The moment it was granted, they have vested. Okay, at the end of the period on 31st March 20x1, it is expected that 95% of total employees will exercise the option. Okay. 1 second. That vest immediately. All right. Will exercise the option. 92% of total employees will exercise the option at the end of the next year. Finally, 89% only will be vested at the end of the 3rd year. Fair values at the end of each period have been given below. So what are you given? The fair value of SAR is 112, 109, 114. You are required to pass the journal entries. Okay, so we'll do a quick employee benefit table. Okay, so similar table we have prepared. So calculation of employee benefit expense. Calculation of EBE. All right. Calculation of employee benefit expense. All right. So now three years. How many option rights? Number of SARs? 10,000. I think, 1 second. Okay. Number of SARs multiplied by what is your expected vesting. Okay, using an option pricing model at that date, it is estimated that the fair value is rupees 95. So this 95 is just the value on the grant date, but we are doing a SAR. We are not doing a stock option. So therefore, we have to remeasure it at the end of each reporting period. Using an option pricing model, estimated, okay, SAR can be exercised at any time up to 31st March. At the end of the period on 31st March X1, it is expected that 95% of employees will exercise the option. So into expected exercise. Expected exercise, 95%, 92%, 89%. 95%, 92%, 89%. Okay. And what is the fair value? Multiplied by fair value. Now here, the fair value cannot be the fair value on grant date. This is a financial liability. At the end of each reporting period, it must be remeasured. So 112, 109 and 114. Okay, so 112, 109, 114. So this gives you the total value of options, okay, or what we call as total employee benefit expense. Total employee benefit expense. All right. Now, 10,000 into 95% into 112, that gives you 10,64,000. Next, 10,000 into 92% into 109, that gives you 10,02,800, and this gives you 10,14,600. Please tell me if I am being too fast so that I can wait for some time. But if not, then please copy this. Okay. So total EBE 10,64,000, 10,02,800, 10,14,600. Now see, these options have already vested. That means, as I have mentioned, this is the SAR which is given for service already rendered. That means I have to recognize the employee benefit expense straight away on the grant date. I have to recognize the employee benefit expense directly on the grant date. And on the grant date, the value of the SAR is 95 rupees. The value of the SAR is 95 rupees. So therefore, on the grant date, that is, what is the grant date? 1st April 20x0. On 1st April 20x0, you will already pass the entry employee benefit expense account debit, which goes to the P&L, to SBP liability. To SBP liability. This is 10,000 options into rupees 95, if I am not mistaken. So this is 9,50,000. That means on the grant date, book the expense. Why? Because immediately vested. So you can write here immediate vesting. Immediate vesting. Now, at the end of each reporting period, what are you doing? Sir, two things. One is how much is expected to be exercised, and the second one is the fair value remeasurement. The fair value remeasurement. So total EBE is 10,64,000 less recognized previously. So that is 9,50,000. Sir, when did I recognize this? On grant date. Why on grant date? It has vested immediately. So that leaves you with how much? That leaves you with 10,64,000 minus 9,50,000, 1,14,000. EBE for the year. Second year, 10,02,800, out of which I have already recognized totally 10,64,000. So the difference 10,02,000 minus 10,64,000. Here I am getting something interesting. 61,200 negative. And in the third year, it is 10,14,600 minus what I have recognized previously, 10,02,800. So that gives you 11,800. Have you understood this part? There is something which is not normal. So I will ask about that. But first, up till now, is it clear? Up till now, is it clear? Please tell me. Is it clear so far? Something has happened which is slightly off track. Okay. So I want you to tell me so far, have you understood this? If yes, what is off track? You would already know what is off track, and tell me what do I do about that off track thing. Okay. Arey, have you understood, guys? Any doubt so far? Sairam, Principria, who else were there in the last session? Kritarth was there. Namita, are you there this side? And there was one girl, Tanushri, I guess. Tanushri, are you there? Sairam is there. Who else were there in the last class? Sir, in second, there was the negative expense. That means these expenses will be reversed back. Guys, anybody else? Please share your answers. Who else? Kritarth, Priya, Jay Srivastav. Are you there? Vidula, Chanda Devi. Are you guys there? Okay. All right. Yes, sir. It is clear. No doubts. Okay. Now, Jay has asked a question, sir, had it been an option, then the fair value at the grant date with no remeasurement would have been taken. Absolutely right. Absolutely right, Jay Srivastav. This is a SAR, and that is why the fair value is taken at the end of each reporting period. If it were to be a stock option, you would take the fair value as on the grant date. You would take the fair value as on the grant date. Okay. So now the normal thing is EBE for this year, EBE for the third year, you would pass the entry employee benefit expense account debit to SBP liability, and the same entry here also to SBP liability. Okay, so this is what you will be passing for this amount. The question is this interesting one, which is 61,200, which is 61,200. Now for this 61,200, what is abnormal about it? Sir, expenses are negative. Can expenses be negative? Ho sakta hai. See, it is an estimate at the end of the day. Okay. So I estimated by 31st March X1 that more employees would exercise the option, and that is why would exercise the SAR, and that is why I booked a higher expense in 31st March 20X1. But by X2, I noticed that those many employees will not exercise the option and the SAR, and that is why whatever was extra recognized, I have just reversed it. I have just reversed it. Is it normal? Yes, it is absolutely normal. Just to give you an analogy, you used to make a provision for bad and doubtful debts in a particular year. Now, this provision for bad and doubtful debts is based on an estimate. Next year, those many bad debts did not happen at all. So what are you going to do with that provision? Sir, that provision we will have to reverse it. And when you reverse it, expenses will be credited, the P&L will be credited. It will be shown as a reduction from expenses, but ultimately the credit goes to the P&L, right? So this is the same analogy. So now for this, you will have the reverse entry, SBP liability account debit to employee benefit expense. Okay, for 61,200, for 61,200. Okay, so this is the different thing which is there in your second year. This is the different thing which is there in your second year. All right, so I think you should get a idea of SAR with this. We're doing quite as easy questions because some of the concepts will flow in now once we start the performance conditions. But I hope this is clear to everyone. Srinidhi has also confirmed. Tanushri has confirmed. The reversal is clear to everyone. So with that background, let us now proceed. This question is done for you. Okay. Now, same question is there. Minda has issued 11,000 stock appreciation rights that vest immediately. So same thing, vest immediately on 1st April, 11,000 rights, which will be settled in cash. Estimated that fair value is 100. SAR can be exercised at any time until March X3. It is expected that out of the total employees, 94%, 91 will exercise in years 1 and 2 respectively. When these were vested, only 85% of the total employees exercised the option. So pass the journal entries. So you will have to pass the journal entries. So these are the same entries which we have just now studied. There is no difference in that. Okay. This is also an RTP May 2020 question. Okay. This is also RTP May 2020 question which has flown into your study module. Okay. So I request you to please try this out. It is exactly the same. It is exactly the same. Sir, finally, what is going to happen? They exercise the options. No, so SBP liability account debit to bank. The company has to pay them when they exercise the option. So SBP liability account debit to bank. So I think you should be able to do this question also. It's not difficult. Okay. Please try this question out. Please try it out. Okay. All right. Now, coming on to the next question, that is P limited. Okay. Come to this question 9 of your study module, which is there on page 5.75. P Limited granted 400 stock appreciation rights to each to 75 employees. Okay, 75 employees, 400 stock appreciation rights. All right. On 1st April X1 with a fair value of 200. This is the fair value on the grant date. The terms of the award require the employee to provide service for 4 years. So there is a service condition. There is a service condition of 4 years. In the previous two questions, the options had already vested. That is why on the grant date, we had passed the entry EBE account debit to SBP liability for the entire value on the grant date. Why? Because they had already vested. Now here they have not vested. That is why we will do prorated vesting, 1/4, 2/4, and then we will see what the question tells. The fair value of each stock appreciation right at each reporting date is as follows. You are given fair value for the year ending March X2, March X3, X4, and X5. What would be the difference if at the end of the second year of service? Okay, that is at 31st March 20X3, P Limited modifies the terms of the award to require only 3 years of service. To require only 3 years of service. All right. So now what is happening is, first they have asked what is the regular accounting. Then they have said in the second year, they have modified the option. They have modified the SAR to require only 3 years of service. They've not repriced anything. They've said they're just modifying the service condition. They are just modifying the service condition. So let us pick up this question for solving. Okay, let us pick up this question. This is part 1. Vesting period is equal to 4 years. That is a service condition. That is a service condition. Okay. So now I am having year ended 31st March X2, X3, X4 and X5. X5, 4 years. Okay. So now granted 400 stock appreciation rights to 75 employees. Number of employees, standard table, 75. Multiplied by number of SARs per employee. Well, everybody gets 400. Expected vesting, they have not told anything. That means all of them will ultimately exercise. They have not told who is leaving at the end, how many are leaving, how many are expected to stay, annual departure rate. All this data is not given to us. So number of employees into number of SARs per employee multiplied by fair value. Multiplied by fair value. Sir, which fair value will you take? You will take the fair value at the end of each reporting period. Why, sir? This is a SAR and SAR has to be remeasured at the end of each reporting period. So 210, 220, 215 and 218. Okay. So 210, 220, 215, 218, 215, 218. So this is what is going to be your total employee benefit expense. Total employee benefit expense. All right. So now please do the calculations. 75 into 400 into 210. So this comes to 63 lakhs into pro rata. This is unchanged. So 63 lakhs divided by 4. So that comes to 15,75,000. This is EBE till date. 15,75,000 less previously recognized. How much was recognized? Sir, this is the first year, so that is 0. So this gives me EBE for the year. 15,75,000. Okay. 31st March X3, we are having 75 into 400 into 220. So this gives you 66 lakhs. Second year out of 4. So this is 2 by 4. So this is 33 lakhs. How much is previously recognized? 15,75,000. 17,25,000 is the expense for the second year. Next, 75 into 400 into 215, 64,50,000, 3 by 4. 48,37,500. How much is recognized already? 33 lakhs. 15,37,500. And then 75 into 400 into 218, 65,40,000. Now though the period is done, so 65,40,000 earlier recognized is 48,37,500. So minus 48,37,500. So 17,02,500. 17,02,500. This is what is going to be your expense. So each year, what is the entry that you are going to pass? Entry will be employee benefit expense, which ultimately goes to the P&L to SBP liability. To SBP liability. Are you guys solving along with me? Yes? Or it's too elementary for you? Are you guys there? Have you understood so far? $15 lakh, 75,000, 17 lakh, 25,000, 1537, 500, 1702, 500. Okay, so this is the entry that you are going to pass. Is it clear so far? Is it clear so far? Yes. Solving. Kritarth is saying yes. Okay, great, great. So EBE, which goes to the P&L account debit to SBP liability. You can call it employee benefit expense, employee compensation expense, whatever you want. Once you are done, please let me know. Any doubts also, please do inform me. Krutarth is there. Namita is not there. Correct. Jay is saying in the year 31-3, this is the second part of the question. Yes, that's right. Okay. So I'll come to that, but you are right. Okay. So Jay, if you can, please try to solve the remaining one. Okay. All done. Srinidhi has confirmed. Priya has confirmed. Now we move on to the next. What would be the difference if at the end of the second year of service, that is as at 31st March X3, P Limited modifies the terms of the award to require only 3 years of service. Okay. So now what is happening is, first year they gave the award. They thought that okay, we will continue with the 4-year option because first year. So then you prorate it over 1/4. In the second year, the management became generous and then they said, we will not give a 4-year vesting condition. We will give a 3-year vesting condition. Let employees be happy. So then now your option will be vested by the end of the third year. That means this whole thing will not come. Fourth year will not come only. Okay, so now I'm doing the second part. Okay, now I'm doing part 2. Vesting period is equal to 3 years. Vesting period is not 4. It is now changed to 3 years. It is now changed to 3 years. So now what is the fallout of this? The fallout of this is that the prorating that you did in the second year of 2 by 4 will now become 2 by 3. And in the third year, it will not be 3 by 4. It will be 3 by 3. It will be 3 by 3. So with this change, let us proceed to solve the question. This is going to change. This will change. All of this will change. Okay. Yes. So now 66 lakhs into 2 by 3. So that gives you 44 lakhs. Out of 44 lakhs, you have already recognized 15 lakh 75,000. So 28 lakh 25,000. And then third case, it is 64 lakh 50,000 full expense minus 44 lakhs. So that comes to 20 lakh 50,000. All right. So this is the change that is going to happen. Your fourth year will not come, obviously, because now the vesting period is modified to 3 years. Okay. Any doubt so far with the second case where there is a change in the vesting period? All clear, boys and girls? Kritarth, Srinidhi, today Vidula is not there, Namita is not there. Who else were there in the last class? Piyush is not there. These many guys and girls are not there today. Okay, understood. Priya has confirmed. Priya Garg. Kritarth Soni has also confirmed. Princy Priya, are you there with us? Have you understood? Srinidhi has also confirmed. All right. So this kind of takes care of that question. No doubts in this now. A SAR question, a simple one at that. All right. You move on to the next question. Okay. Please, first we will just discuss this question, then we move on to the preceding question. ABC Limited granted 500 stock appreciation rights each. This is your exam question. So you can see that it's quite similar to what we have been doing. Granted 500 stock appreciation rights each to 80 employees on 1st April X1 with a fair value of rupees 100. The terms of the award require the employee to provide service for 4 years. The SARs are expected to be settled in cash, and it is expected that all the employees will exercise the option. Fair value at each reporting date is given. Please present the journal entries in the books of ABC Limited over the entire life of the grant. So I think this should not be a problem for you. Yes. All right. Sairam has asked a question. Sir, first year recognition is taken as 4 years. And Tanushri has also asked a question, has a doubt in the previous question. See, when did the change happen? What would be the difference if at the end of second year of service, P Limited modifies the terms of the award? That means first year there was no modification. So when they introduced the plan, what was the service condition? To remain in service for 4 years. This condition is changing in which period? It is changing not in the first year, it is changing in the second year. And therefore, you cannot do 1/3 in the first year. Are sir, first year I did not even know whether it will become 3 or not. I knew it would be 4 years. So therefore, the prorating will happen as 1/4. Second year, when you moved in, the accountant came to know that management has modified the terms for 3 years. So now this is the second year, and the life of the vesting condition is 3 years. So therefore, he has to do it as 2/3. You cannot do pro rata as 1/3 for the first year. Is it okay, Sairam and sir, what is relevant is prorated amount and not the total EBE. See, both are relevant. Total EBE is what is your estimate of the total employee benefit expense over the life of the option. Okay, total EBE means what? Over the life of the option, how much employee benefit are you going to incur? This is your estimate. But even the pro rata is important, because you should know how much should be the expense per year. Sir, you are going to pass the entry at the end of each year, right? You cannot just say, okay, my employee benefit expense over the life of the option is 63 lakhs in this question. Can you sit like that? No, you cannot. Arey bhai, you have to record it over the vesting period, because each year passes, an employee starts getting the right for that option. He is providing the service and he is becoming eligible for the right. So that provision of the service is accruing the expense for you, right? And that is why you will have to record the expenses. That is why you will have to record the expenses by prorating over the life of the option. In this case, it is prorating over the vesting period. Is it okay? So both the factors are important. Total EB also is important. And that total EB itself is what you are going to prorate it over the tenure of the vesting period. Okay, so both are important. One gives you the total EB. The pro rata gives you the expense that you have to recognize at the end of each year. Okay, so both are important. Is it fine? Any other doubts in this question? Jay, did you follow? Jay, did you follow? Yes. Any other doubts? Jay, Tanushri understood. Sairam, did you understand why it is taken as 4 years in the first year? Yes, I hope you have understood that. Okay. So this question, I will leave it for you to solve. Okay, this is a homework question. Okay, and then we move on to this RTP question. An entity which follows its financial year as per the calendar year. Okay, so you have a calendar year here. Grants 1,000 share appreciation rights to each of its 40 management employees as on 1st January 20x5. The SARs provide the employees with the right to receive At the date when the rights are exercised, a cash that is equal to appreciation in the entity's share price since the grant date, which is essentially what is a stock appreciation, right? Ka definition. You are given the grant date price, any appreciation from that, the employee is going to get. All of the rights vest on 31st December X6. When were the options granted? The options were granted on 1st January. When are they vesting? They are vesting on December 6. So 2005 and 20X6. So your vesting period is 2 years. Okay. They can be exercised during X7 and X8. So your exercise period is 2 years. All right. Management estimates that at the grant date, the fair value of each SAR is rupees 11. So fair value on 1st January 20X5 is rupees 11. This is the grant date. And it estimates that overall 10% of the employees will leave during the 2-year period. The fair values of the SARs at each year end are shown below. 31st December 5, 6, 7, 8, the fair values are given to you. 12, 8, 13 and 12. 10% of employees left before the end of 2006. That means you estimated 10% and actually 10% left. Is it mandatory that this happens? No, it doesn't. It is not mandatory. This is just a coincidence. Otherwise, it could be more also, it could be less also. Anything will be given a prospective effect too, because this is just an estimate and estimates can always change. On 31st December X7, when the intrinsic value of each stock appreciation right was 10, intrinsic value. So now there is a new term, intrinsic value. 6 employees exercised their options. The remaining 30 employees exercised their options at the end of 20X8 when the intrinsic value of each SAR was equal to the fair value of rupees 12. How much expense and liability is to be recognized at the end of each year? And you have to pass the necessary journal entries. Okay, so I just need you guys to go through this question once. Okay. Just go through it once. This is an examination question. There is one new term, which is your intrinsic value. There is one new term, which is your intrinsic value. Okay. All right. So I hope you have gone through it. Yes. So now let us understand the concept of fair value and intrinsic value. Let us understand. Intrinsic value was one of the ways we could do the accounting under the guidance note, that is the ICAI regime. Now it's not permitted. Now it is not permitted. But what do you mean by fair value and what do you mean by intrinsic value? Okay, so your fair value is the value determined using option pricing models. Option pricing models means models like Black-Scholes or models like binomial model, etc. Or you could refer to the observable inputs. That is a similar option of your company which is traded in the market. What is its trading value? So that could also be taken to be the fair value. So this fair value is measured by the reporting entity. For financial reporting. This is measured by the reporting entity for financial reporting. Now, do you think that an employee, you are working for, let us say, Tata Motors. Okay, now if you're working for Tata Motors, suppose you've gotten an ESOP with you. Now, how the accounting for that ESOP is done, what is the fair value of that option? Do you, the employee, know that? Answer is no, sir. I do not know that. It requires specialized persons. You need experts to calculate the option prices, to calculate the fair value. And I do not know that. But as the employee, I know one thing. Sir, what do I know? I know that what is the market price of Tata Motors share. The market price of Tata Motors shares is what I know. And as per the award that is given, there is a exercise price. There is a base price that is there on the grant date. And I know the terms of the award. So the terms of the award tell me that you are going to get the difference between market price minus exercise price. This is easy for the employee, right? He knows the exercise price or the value on the grant date. This is something which he already knows. It's given to him. The market price also he can easily find out. What do I do? Well, you just go to the BSE, NSE and look at the market price on that date. So he can easily look at that and he can go to the company and tell market price is, say, 1,000 rupees. You have given this exercise price or value on the grant date as 950. So there is an appreciation of 50 rupees. So give me 50 rupees. So this is what the employee can do. And this 50 is what is known as your intrinsic value. This is what is known as your intrinsic value. Okay. So therefore, there are two different concepts. The fair value is done using an option pricing model or under the principles of Ind AS 113. Employee will never have the resources to determine the fair value and is truly speaking not concerned also. He is concerned with the more visible things. He is concerned with what is the change in market price that happens, and that change in market price as compared to the exercise price, the difference that we get, that difference is known as the intrinsic value. Under the guidance note, accounting used to happen on intrinsic value. In Ind AS, no intrinsic value accounting. You have to do the accounting using the fair value. You have to do this accounting using the fair value. What is the fair value? Basically, your fair value is a forward-looking value in this case. It is going to look at what could be the prices in the future and determine the value right now. Because your binomial model is nothing but an expectation of movements in the fair values in the future, and that you bring it to today's times, and that gives you the fair value of the option. If you look at observable inputs, well, that is how the market is behaving right now. So that is going to be your fair value. Intrinsic value, you cannot do your option pricing because that is based on some incremental value which does not reflect the true value of the option. So therefore, intrinsic value accounting is totally deleted from your Ind AS 102. But that is important from the perspective of the employee. With this background, let us proceed to solve this question. The first thing is calculation of employee benefit expense. What is your vesting period? Sir, my vesting period is 2 years. So the EBE will accrue over a 2-year tenure and it will be exercised over a 2-year tenure. Okay. So 20x5 20x6. Okay. An entity grants 1000 shares to each of its 40 management employees. It expects that 10% will leave. So number of employees. When is this? End of vesting. End of vesting. That is 40 into 90%. 10% expected to leave. So 40 into 90%. So that gives you 36, 36 multiplied by number of options per employee. Multiplied by number of options per employee. So how many options are given? 1000 SARs. 1000 into fair value. Sir, which fair value are you going to use? You are going to use the fair value on the grant date or the fair value at the end of each reporting period. Obviously fair value at the end of each reporting period, because this is a SAR. You are going to give cash. So rupees 12 and rupees 8. So this is rupees 12 and 8. All right. So that gives you total EBE. Total employee benefit expense. This is in rupees. So 3600 into 12, 43,200, 4,32,000. Multiplied by pro rata. 1/2, 2/2. EBE till date. This gives you 2,16,000 and this is 2,88,000 less previously recognized. First year 0, second year this is what is previously recognized. $2,16,000. This is 72,000. EBE for the year. Please. So the journal entry for these two items is going to be EBE account debit, which goes to your P&L, to SBP liability. $72,000. So far, is it clear? So far, any doubts, guys? Yes. Any doubts so far? Please let me know. Are you clear about fair value vis-a-vis intrinsic value? fair value is the estimate of value of employee's service excluding the salary. Yes, this is not related to the salary that they are getting for the work that they do. Okay, the work that they do, you are compensating them in the form of cash, that is the monthly salary payments. You are compensating them in the form of leave encashment. You will compensate them in the form of gratuity. You will compensate them in the form of PF ESI contribution. All of that is covered under another standard, Ind AS 19. Okay, Jay, that is Ind AS 19 deals with employee benefit expenses. Ind AS 19 excludes 102. Okay, that means payments made to employees based on shares. It is an exclusion, scope exclusion in Ind AS 19. It is covered here under Ind AS 102. Okay, so Jay, I hope I got your question right. Okay, so Srinidhi has understood. Anybody else? Any answers? Jay, understood? Yes. All right. Now, we are done with the vesting period. Now we move to exercise period. Before moving to exercise period, balance in SBP liability account. Balance in SBP liability account. What is this SBP liability account balance? Sir, this is 2,88,000. This figure. 2,88,000. 2,88,000. Or I can also say that it is 36 employees into 1,000 into rupees 8. 36 employees into 1,000 options into rupees 8. All right. Balance in SBP account on 31st December 20x6. This is when your vesting period is over. This is when your vesting period is over. Now you start to exercise. On 31st December X7, when the intrinsic value of each SAR was rupees 10, 6 employees exercised their options. So 31st December 20x7, options exercised by how many employees? 6 employees. So what will be the journal entry? Exercise means what? They'll go to the company and say, look, this is the change in the value, intrinsic value. So please pay us the intrinsic value. So therefore, what will be the entry that will be passed? SBP liability account debit. Sir, what are you going to debit the SBP liability account with? Well, 6 employees exercise the option. So 6 employees. Each employee has 1,000 options. And the SBP liability option value was the fair value on 31st December X6, which is rupees 8. So into rupees 8. So this gives you 48,000. This gives you 48,000. Leave 1 or 2 lines and then write down. It is a SAR. So you will pay the money. when they have exercised. So to bank, how much are you going to pay? Sir, I am going to pay to 6 employees, each of them having 1,000 options. How much will I pay them? You will pay them the intrinsic value. That is the difference between the exercise price and the market price. That difference is rupees 10. That difference is rupees 10. So 6 into 1,000 into rupees 10. This gives you 60,000. This gives you 60,000. The liability was 48. You have settled by paying 60. So where this difference will go? There is a difference of 12,000. Come on now. Think and answer where this difference of 12,000 will go. Obviously, it goes to the P&L. As what? It will go as compensation expenses or employee benefit expenses. Okay, because it's given to your employees as they have exercised the option. So the entry will be EBE, which ultimately goes to P&L. Debit. How many? 6 employees into 1,000 options into your intrinsic value that you have settled is rupees 10. But the options were appearing in the previous period closing at rupees 8 fair value. So into 10 minus 8. So instead of a balancing figure, you can do it like this also. 6 employees, 1,000 options into 10 minus 8. So that gives you EBE expenses. Excellent, Kritarth. Girls, Tanushri and who is that other lady? Srinidhi. Sairam, are you there? Princy, Priya, are you guys there? Yes. So this will go to EBE. This will go to employee benefit expense. Are we done for the year 20x7 or is there anything which is left? Should I proceed to 20x8 the last year or is there anything which is left? Is there anything that's left? Or can I straight away proceed to 31st December x8? Can I go to x8? Yes, Kritarth has asked a question. What will be the role of rupees 13 fair value? Wohi role to aayega abhi. What are these? These are SARs. And what do you mean by SARs? It is a financial liability. And when it is a financial liability, what do I have to do? I have to remeasure the option. I have to remeasure the option. So presently, your options are appearing at rupees 8. The previous reporting period's fair value. Now the fair value has gone up to 13. So you will have to therefore increase your liability by rupees 5. Increase the liability means credit the liability. What are you going to debit? EBE account you are going to debit, because this is a loss on remeasurement of employee SARs. That is why it goes to employee benefit expense. This part generally students could miss. Okay. So options unexercised. In respect of how many employees? 30 employees. How do I calculate this? Well, EBE, which goes to the P&L debit, to SBP liability. How do I calculate this? This will be calculated as 30 employees who have not yet exercised multiplied by 1000 options into fair value is rupees 13. Your options are appearing at 8. Your options are appearing at 8. So 30 into 1000, 30,000 into 5, 1,50,000. 1,50,000. Are, have you understood now? Have you understood this? This entry, there is a chance of missing it out. Okay, so this entry is important. All right, next one, 31st December. Acha, before that, balance in SBP liability as on 31st December X7. There are two ways of calculating. First way is opening was 2,88,000. Out of that, 48,000 went in exercising, and 1,50,000 was the increase in due to fair value. You could do it like this, or you could do it as how many employees? 30 employees into 1000 options into rupees 13. In either cases, it will come to rupees 3,90,000. It will come to 3,90,000. Done. And then we move on to 31st March 20X8. All options exercised. All options exercised. All options exercised. So now the entry will be SBP liability account debit. SBP liability account debit. How much? 30 employees into 1000 options. You will debit it with rupees 13. That is the fair value. So 30 into 1000 into rupees 13. So that gives you 3,90,000 to bank. This is the settlement. What is the intrinsic value? The remaining 30 exercise their options when the intrinsic value of each SAR was equal to the fair value of rupees 12. Intrinsic value 12 tha. So this comes to 30 employees into 1,000 options into rupees 12. So this is 3,60,000. And difference, where will it go? To EBE, which ultimately goes to your P&L as a reversal. You can calculate it as a balancing figure of 30,000, or you can calculate it as 30 employees into 1,000 options into your options were appearing at 13, but you are settling it for 12. So this is how the SARs will be accounted. This is how the stock appreciation rights will be accounted for. And as you can see, 3,90,000 was the balance that is fully eliminated. So if I have to write balance in SBP liability as on 31st December X8. This is started with 3,90,000 credit minus 3,90,000. So this is 0. Any doubts, anyone? In year 20X7, can the first SBP liability be increased to 13 for 6 employees? No. It cannot be increased to 13 because of the simple reason that these employees are already exercising the option. And when they are exercising the option, it means that as on the closing date, when you are preparing your balance sheet, okay, all entries are done. These 6 employees do not have those options. Basically, by settling them, you have settled that option. So therefore, those 6 employees options are not technically outstanding as on the last day. And because they are not outstanding, you cannot increase it to 13 and then go for a settlement. Okay. Even suppose you increase and go for a settlement, net impact will be the same. Okay. So therefore, our approach is going to be that we will not increase it to 13 first and then do the settlement. Ultimately, it has to go. Yes, ultimately that value has to go. So therefore, it is directly settled. Okay, it's directly settled. It's not outstanding. You can only fair value those options which are outstanding on the last day. Okay, which are outstanding on the last day. All right. So that takes care. Anybody has any doubt? Srinidhi, Tanushri, Sairam, Princy, Priya, Garg. It's clear. Okay. So now this concludes. If you look at our questions, I think SARs, all the questions we have more or less discussed. Okay. So I just request you to go through this theory. We told initial measurement, remeasurement needs to be done. change in classification is just theory. Okay, and then you have the questions. Okay, so just go through that small discussion that is there, and now we shall come to vesting conditions in detail. Okay, and let us understand the impact of vesting conditions with the help of questions only. With that way, what happens? I can hit two birds with an arrow. Okay, that is the first thing is I can explain the concept also. At the same time, your question also will be solved. Okay, so let us just start off with that. 1 second, please. Okay. All right. Sir, please do December 2021 examination question. Preeti Agarwal has asked it. Okay, I will check that. Okay, I don't think I have downloaded it here. I'll go through it. Okay. Now, I'll have a look at that. Okay. Now, vesting conditions. All this theory is there. So what I want you to do is just understand the concept. Okay. Vesting conditions are of two types. One is service condition, the other is performance conditions. Whatever questions we have done till now, it is all related to service conditions. So now we shall move to vesting conditions which are performance based, Performance based conditions means what? Performance based conditions means they could be of further two types. One is market linked performance condition. The other is non-market linked performance condition. Market linked performance condition क्या होता है? Where you have conditions that say options will vest if the share price touches a particular level. That becomes a market linked condition. Non-market linked condition means what? Non-market linked condition means these conditions could be such as increase in market share of your product by 10%. That could be one. Increase in revenue by so much percent. Decrease in cost of production by X%. All these are your non-market linked performance conditions. The accounting treatment of market linked conditions vis-a-vis non-market linked conditions are entirely different. Okay. The more complex one is, I won't say complex, but the lengthier treatment is the non-market linked condition. What do you mean by that? What is the treatment in the case of non-market linked condition? Well, Ind AS 102 requires you to estimate the vesting period at the end of each reporting period. You estimate whether the options will vest based on the performance condition that you have set, and you estimate within how many years it is going to vest. That means on the grant date, you have given an option. These options have a performance condition. Let us assume a particular revenue target. Okay, your revenue must increase by, let us assume they have set a target, your revenue must increase by 30% over 3 years. Now, if you give this target, when are you actually going to know whether revenue has increased by 3 years or not, by 30% or not? Sir, you will come to know that only at the end of the 3rd year. Sir, so does that mean we will not book the expense until the 3 years are done? Answer is no. That is not right, because employees are working hard to meet the revenue target of 30%. So therefore, So therefore, you cannot say that I will book expense on actual basis. You would be violating the accrual concept, because employees today are striving to meet 30%. That means efforts are being put in today. And when they are rendering service today, you will have to recognize the cost thereof. You will have to recognize the cost thereof today itself. That is the simple matching principle that we have. Though it is not a part of my framework, still, wherever possible, we will obviously try to strive for matching. So now the important part is, I do not know whether they will touch 30% or not. But sir, at the end of each reporting period, can you estimate whether you will touch? हाँ, वो तो मैं कर सकता हूँ. I can definitely estimate whether the entity will meet the targets or not. So at the end of year 1, you will estimate that, for example, the options will vest at the end of second year because the revenue target of 30% increase is met in 2 years itself. If that is the case, then at the end of first year, your vesting period will be 2 years. So you will prorate how much? You will prorate it as 1/2. You will prorate it as 1/2. Suppose you estimate that 30% revenue increase will be met by the third year, then your vesting period will be 3 years. But this you will have to do it at the end of each year, at the end of each vesting period. Okay, so this you are going to do. So now the more important thing is, each year you carry out an analysis. You look at the past performance, what are the targets they have met, and then you estimate as the entity when this condition will be fulfilled. If at all it will be fulfilled or not, that also you will have to check. If it doesn't fulfill, that means these options will not vest. And if these options will not vest, you cannot book these expenses. You cannot book these expenses. We are talking only about non-market linked conditions for your information. Okay. I am not discussing about market linked conditions right now. So at the end of each vesting period, at the end of each reporting period in vesting period, estimate 1 probability of vesting. Sir, whether my condition will be met or not, that condition you will, that probability you will estimate. And expected year of vesting. You will have to estimate these two things. And based on these two estimates, you will perform your accounting. You will pass the journal entries. And accordingly, we shall, pass the journal entry. So with this background, I think you should be able to do the next couple of questions which are there. So come to this illustration 7, which has already been asked twice in the exam, November 2018 as well as May 2019. That is 8 marks question. So Ankita Holding grants 100 shares to each of its 500 employees on 1st January 20x1. The employees should remain in service during the vesting period. So there is a service condition also. Along with the service condition, there is a condition that the shares will vest at the end of the first year if the company's earnings increase by 12%. Okay. So suppose in first year itself, you have increased your earnings by, let us say, 15%, then vesting period is already over. End of year 1, your options have vested in you straight away. But suppose if it doesn't, then it will vest at the end of the second year if the entity's earnings increase by more than 20% over the 2-year period. So at the end of year 1, you have not completed, you have not achieved the increase of 12%. हाँ sir, हमने achieve नहीं किया. So now what you have to do, you will have to estimate whether I'm going to meet the 20% target in the next year, 20% average. If not, then in the third year, if earnings increase by more than 22% over the 3-year period. So this is what is your performance condition. This is what is your performance condition. And it is which type of performance condition? Is it a market linked condition or a non-market linked condition? Sir, this is a non-market linked performance condition. Why? It is focusing on your earnings. Okay. The fair value per share at the grant date is rupees 122. Sir, it is an ESOP. So grant date ka fair value only will continue. In 20x1, earnings increased by 10%. That means now you tell me whether at the end of year 1, the condition is fulfilled. Answer is no, it's not. So therefore, the options will not vest at the end of the first year. So now at the end of year 1, you have to estimate two things. First thing is whether you are going to meet the vesting conditions of 20% average or 22% average, as the case may be. And second, if yes, when are you going to meet it? So now you can read the information. In 20x1, earnings increased by 10% and 29 employees left the organization. Okay. The company expects that the shares will vest at the end of the year X2. That means the company thinks in the second year, we will be meeting the performance condition. Which condition? 20% average over the 2 years. And therefore, it is saying that the vesting will happen at the end of the second year. So you will do a pro rating of 1/2 for year 1. You will do a pro rating of 1/2 for year 1. The company also expects that additional 31 employees will leave the organization in 20x2 and that 440 employees will receive their shares at the end of year 20x2. At the end of 20x2, the company's earnings increased by 18%. So first year 10%, second year 18%, totally it is 28%, right? So 28% divided by 2 is 14%, which is less than 20%. And therefore, have the options vested in the employee at the end of year 2? Answer is no, it hasn't. So now what you have to do at the end of second year, you will again do an estimate. So here they have spoon fed and told you, therefore the shares did not vest. Even if they were not to give that, you are expected to calculate that. Only 29 employees left the organization during X2. Company believes that an additional 23 employees will leave in X3 and earnings will further increase so that the performance target will be achieved in X3. At the end of year X3, only 21 have left. Assume that the company's earnings increase to desired level and the performance target has been met. And accordingly, you determine the expense for each year and pass the appropriate journal entries. Have you guys understood the question? So what is your vesting conditions? Sir, my vesting conditions is earnings increase, average earnings increase per annum. If it is 12% per annum, then vesting will happen in year 1. If it is not 12%, but you move to 20% per annum, then vesting will happen in year 2. And in year 3, it is 22%. 22% per annum. So this comes to vesting at the end of the 3rd year. At the end of the 3rd year. Right. So therefore, end of year 1. End of year 1. What is the growth that you have achieved? 10%. So no actual vesting. No actual vesting as earnings growth is less than 12%. It is 10. वो 12 तो नहीं है, and if it is not 12, then there won't be any actual vesting. Okay, but now can you just sit like this at the end of 2nd year? Arey sir, options have not vested. No, you have to do an estimate. So what is your estimate? Company expects that the shares will vest at the end of the year X2. At the end of the year X2. Okay, so now expected to vest at end of 20x2. At the end of 20x2. So what is your vesting period now? Vesting period is 2 years when you are doing the accounting for year 1. When you are doing the accounting for year 1. Is it okay? Yes. And now you move to year 1 account is closed. Year 2 has started. Year 2 has completed. End of year 2 aa gaya. Now you will check actual earnings growth. Actual earnings growth is equal to first year it increased by 10%. Second year it increased by 18%. So 10% plus 18% by 2. So that comes to 14%. That comes to 14%. And 14%, is it meeting the performance condition? No, sir. Performance condition is more than 20%. So this is less than 20%. Therefore, options will not vest in year 2. Options will not vest in year 2, but expected to vest in year 3. वो इधर दे के रखे. Company believes that earnings will further increase so that performance targets will be achieved. And did they achieve it? Yes. So assume that the company's earnings have increased to the desired level and the performance target has been met. And performance target meet ho gaya, then end of year 3, options would have vested. Options vested actually. आपको कैसे मालूम? Sir, this is given in the question. This is given in the question. Are, have you understood? Did you guys understand the question? Are, bolo. Any question? Sir, why you have taken average of 2 years profit? Because look at the condition, no? If entity's earnings increase by more than 20% over the 2-year period, that means this is average only, no, Sairam? So that is why we take average of the 2-year profit. Okay, over the 2-year period, it must cross 20%. Yes or no? Did you understand, Sairam? Anybody else has any other doubt? Okay, Sairam has confirmed. So let us proceed to solve this now. Okay, let us proceed to solve. So this is a performance condition which is non-market linked, and because it is a non-market linked performance condition, we will have to estimate. Okay, so you are having reporting period estimate of ultimate vesting is the data given to you. This is going to be yes or no. Estimated vesting period. Okay, so X1 year ending 31st December 20X1. Estimate of ultimate vesting. Do you think it will vest? Answer is yes. When do you think it will vest? At the end of year 1? Sir, you think that it will vest at year ending 31st March X2. Sorry, 31st December X2. My mistake. Okay. You come to the second year end 20X2. Do you think that it will vest? Answer is yes. But this is year ending 31st December X3. 31st December X3. Year ending 31st December X3 actually vested. Actually vested. Is it okay? Yes. Based on our discussions, this is what is the expectations. This is what is the expectation. And now you proceed to calculate. Calculation of EBE. So how many years until you vest? 3 years. Okay. Based on the data that is given. Based on the data that is given. Yes. Number of employees at the end of vesting. Number of employees at the end of vesting. Read the question now. 500 employees were there on 1st April X1. 29 employees left the organization, and it expects that additional 31 employees will leave. So 500, how many left? 29 left. And it expects that a further 31 is going to are going to leave. So this is 500 minus 29 minus 31. This gives you 440, 440 employees. This 29 is actual, so I'm writing it as A. 31 is estimate. You have estimated it for only 2 years because you are expecting the vesting to be 2 years. All right, multiplied by number of options. How many options? 100. Multiplied by fair value on grant date. It is a share option and therefore no remeasurement. What is the fair value? It is rupees 122. It is rupees 122. So total EBE in rupees, 440 into 100 into 122, 53,68,000 into pro rata. Now pro rata will be how much? Sir, I expect the options to vest at the end of second year. So pro rata will be 1/2. So that gives you EBE till date, 53,68,000 divided by 2. 26,84,000 less previously recognized. First year hai, so this is 0. 26,84,000. EBE for the year 26,84,000. Is the first year calculation clear? Is the first year calculation clear? Yes. Are we together? Done? All right. So we move on to the next one. Now, in the second year, what is the number of employees? Sir, the company expects that at the end of X2, earnings increased by 18%, shares did not vest, only 29 employees left and a further 23 are estimated to leave. So 500 were the number of employees, 29 left in year 1. This is actual. 29 left in year 2. This is also actual. And now you think that the vesting will happen in the third year when you expect 23 to leave. So this 29 is actual. This is actual. This is estimated. So you estimate the number of employees to be how much? 500 minus 29 minus 29 minus 23. 419. Fair value, number of options 100, fair value on grant date 122. 51 lakh 11,800. 2 by 3. Why 2 by 3? Now it did not vest at the end of second year because you know that we have not met the condition. So therefore, as a result of that, we expect now it will be met in the third year. So 2 by 3. Okay, so 51 into 2 by 3. 34,07,867. Minus 26 lakh 84,000. So 723,867. 7,23,867. And finally, they have given that the options have actually vested in the third year. At the end of year 20x3, only 21 employees have left. So kitne employees bachte hain? 500 original minus 29 minus 29 minus 21. All these are actual employees who have left. So 500, 29, 29, 21. So 421. 100 options, 122. Into 100 into 51, 36, 200. 3 by 3. So 51, 36, 200. Previously recognized was 34, 07, 867. 17, 28, 333. EBE for the current year. Are, have you understood the question? Okay, Princey. So I hope that you have picked up, or you can watch it in the subsequent after the streaming is done. Are guys, did you understand the solution? Yes or no? Preeti, for December 2021, there is a concept of cash settled options, cash settled SBP with an equity option. So I'll be teaching that and then I will be doing it. Okay. Understood. Okay, Tanushri has understood. Looks like only a handful of you guys are there. Okay, so what is the question demanding? Determine the expense for each year and pass appropriate journal entries. Journal entry kya hoga? EBE account debit to SBP reserve. It will be employee benefit account debit to SBP reserve. And at the end, 51,36,200 will be transferred to equity capital and securities premium. That data is not given to us. Okay, so straightforward. So this question is done. Okay. Now let us come to similar questions where we have non-market conditions again. ACC Limited granted 10,000 share options to one of its managers. In order to get the options, the manager has to work for the next 3 years in the organization, reduce the cost of production by 10%. Okay. Fair value of the option at the grant date was rupees 95. Okay. Cost reduction. You have achieved the cost reduction in year 1, 12%. See, you have to achieve a reduction of 10% over 3 years. Huh? It's not each year. See, previous question, it was given as a vesting that happened phase wise. If you met 12%, first year it will vest. If you met 20%, second year it will vest. If you met 22% increase, third year it will vest. But in this case, this 10% decrease must be over a 3-year period. In other words, when are you going to come, when are you going to know whether the options have actually vested or not? Sir, you will come to know at the end of the third year. In the previous question, at the end of each year, you came to know whether it was vested for that year or not. So at the end of each year, you would also do an estimate. Okay. In this case, at the end of each year will not come to know whether it has vested, because the performance condition is talking about 10% reduction over the 3-year period. So therefore, at the end of each year, you just have to do an estimate. So cost reduction achieved. Year 1, you achieved a 12% reduction. Based on that performance, the management thinks that this fellow will reduce the cost by 10% over 3 years, and therefore they said that it is going to be achieved. It's not vested, mind you, it is not vested, it is expected to be vested. They are two different things. Okay, in the previous question, if we had to meet the target of 12%, options would have vested in first year only. यहाँ पे ऐसा नहीं है. It is 10% average over 3 years. So I need you to look at the question 100,000 times correctly before you try to solve it. Okay. So many times we try to make a silly mistake, which is going to cost us badly in the exam. So this is reducing cost of production by 10% over 3 years. So first year performance, the management saw, they estimated that the options will vest, and therefore they gave the estimate that it will be met after 3 years and these options will be vested. In the second year, he could achieve a reduction of only 8%. So second year mein hi, they got an average of 10%. So the management thought, well, we do not know how this guy will take us ahead. There is a drastic, what you can say, increase in cost. So cost reduction could not be met. And therefore, the management says, we do not expect this option to vest in the future. We do not expect this option to vest in the future. And in the third year, he has actually achieved a reduction of 10%, and as a result, he met the condition of 10%, and therefore in the third year, the option has vested. The option has vested, the target is achieved. So now the question is, how would you record the expenses? How would you record these expenses? So it's quite simple. It is a service condition. It is a service condition. So you have to first estimate when are you going to meet the condition. Okay. So we'll do this last question before the break. After the break, I can pick up some other important concepts. Okay. And today class will go on a little longer so that I have to complete the standards. Okay. All right. Average cost reduction estimate. Sorry. I don't need that. I need to prepare this table. Reporting period. and estimate of ultimate vesting. Last one is estimated vesting period. So the reporting period, year 1, end of year 1, end of year 2, end of year 3. Whether vesting will happen at the end of the, whether you expect the vesting to happen, answer is yes. What will be the vesting period? 3 years. At the end of year 2, do you expect the vesting to happen? Based on the data, they say that it is not expected to vest in the future. So no, not applicable. And whether vesting will happen, this is yes, actually. Now there is no estimate. Okay. 3rd year. Actually. This is no longer an estimate. This is no longer an estimate. Yes, this is all service cum performance condition. Performance condition, which is a non-market linked condition. Non-market linked condition. Okay. So now, calculation of EBE. Calculation of employee benefit expense. Year 1, year 2, year 3. Okay, so now when I talk about year 1, year 2, year 3, number of employees. Yeah, there is just one employee multiplied by options per employee. How much is there? 10,000 operations to one of its managers. 10,000, 10,000, 10,000 into fair value. Sir, this is a stock option. So fair value is given to be 95. So 95, 95, 95. Total EBE. First year, 9,50,000 into pro rata. 1/3. That leaves you with 3,16,667. Till date less earlier recognized. First year, so nil. So this is 3 lakh EBE current year. Now in the second year, we expect no vesting to happen, and therefore total EBE must fall to 0. Because at the end of the second year, I have an estimate that this fellow will not meet the target of 10% average cost reduction at the end of the third year. And therefore, the management estimates that no EBE should be recognized. So pro rata, kuch nahi aayega, nothing will come. So EBE till date is nil. 3,16,667. So what are you going to do? Sir, you are going to reverse the expenses. You are going to reverse the expenses. And in the third year, sir, in the third year, so actually I met the target. So therefore the options are vesting. So 9,50,000 pro rata 3/3. So this is 9,50,000. Till previous year, nothing was recorded. So 9,50,000. So what is going to be your entry for the first and the third year? The entry will be EBE expense to the P&L to SBP reserve. To SBP reserve. Okay. And for the reversal, what is the entry? Reverse entry. SBP reserve to EBE P&L. Just the reversal entry. Okay. So EBE will be credited. This is not income. It will be reduced from the regular EBE that is there. There is regular EBE, salaries, wages, contribution to welfare funds, etc., etc. That whole thing makes up your employee benefit expense. From that, this 3,16,667 will be reduced in the second year. In the third year, you will again have a 9,50,000. Have you understood this? Have you understood this part? Did you guys understand this? Arey bolo. See, the problem with, so now, if there is one over smart management in a company, look at the second year. Second year, if we have some over smart guys in the management, look at how they can manipulate the results. Okay, see, in year one, they would be having sufficient profits. So they think that, chalo, we will take the vesting for this. In year two, they may not have adequate profits. They want to maintain the profitability. So what they say, hai na, pada, there is this SBP reserve that is there. It is anyways based on estimates. So when it is based on estimates, we will think that these options do not vest. When we think that these options do not vest, then what are you going to do? Sir, you will have to reverse it. And when you reverse it, what happens? My expense goes down, my profit goes up. And when my expense goes down and profit goes up, ultimately, what are you doing? You are manipulating your results in the name of change in accounting estimates. So therefore, I think there is a standard on auditing which you should be aware of, SA 540. That deals with auditing accounting estimates. So you are not only, what is there? Yahan pe there will be a journal entry that is going to be passed, and they'll write the narration being reversal of employee benefit expense as per management's estimate. Now, what are you going to vouch this with? Okay, so you don't have a document to vouch it because it's just a JV that is passed. So you will have to evaluate the estimate that the management has calculated. You have to hunt for information as to how they got this particular estimate as a part of your audit. Okay. Sir, how to bifurcate the total EBE expense for SBP reserve? What is there to bifurcate? It's total, na? 3,16,667 is there. I did not understand what you mean by bifurcation, Sairam. Entire EBE goes to SBP reserve only, no? And from there only it is getting reversed. So what is the bifurcation? I'm not clear. Okay, your question, if you can reword it, I will be happy to address. Okay. All right. So this issue is there with these estimates. Okay. So change in estimates. have to be viewed with suspicion because they could amount to window dressing or profit manipulating. Okay. So that takes care of this question. We take a break for 5 minutes and after that we shall resume the session. Okay. I'll see your queries. Please post your queries. I'll address them after the break if there are any. Okay. Nisarg. We take a break. Okay. All right. Welcome back, guys. So I hope you have understood the accounting for performance conditions which are non-market linked. Okay. See, there are some small questions like the major chunk in this standard is related to employee benefits. Now, when it is relating to other benefits, like you have a contractor who is giving you services, or you are purchasing property, plant and equipment, then how do you do the accounting is the question. So in that case, the standards guidance is very clear. You have to take the fair value of the item that is being acquired. Okay. If that is not reliable, only then you take the fair value of the shares that you are issuing or the fair value of the options that you are giving. Okay. So basis that you have this small question, please go through that as homework. Okay. I have done this question for you. This also I'm leaving it for homework. Though chota questions hai, you should be able to do it. Okay. You should be able to do it. All right. Now, I'm giving this question also for homework. It is a non-market link performance condition. Entity X grants 10 shares to each of its 1,000 employees on the conditions as mentioned below to remain in service. So this is a service condition also, and the entity's PAT shall reach to 100 million. So the profit after tax should be 100 million at the end of the period. It is expected that PAT should reach to 100 million by the end of 3 years. Fair value at grant date is 100. The employees expected for vesting, right, by first year 97%, 95% by second year, finally to 93% by third year. So calculate expenses in respect of share-based payment. Simple question, not at all difficult. Okay, so you should be able to do it. All right. Next one is okay, market. 1 second, please. Yes. Okay, let us pick up this question. This is one extra question which is not there in your study module. Compute the expense to be recognized in the following case. It is similar to what we have just now done, but just for certain additional clarity, I have kept this. Okay. Slide 56. Compute the expense to be recognized. Share options granted 25,000. Vesting conditions. If the product X's market share exceeds 25% at the end of 4 years. So vesting will happen if the market share crosses 25% at the end of 4 years. Estimated and actual forfeiture rate is 8%. This is employees. Okay, this is employees or what you call as options. Okay, number of employees are not given, options are given. So forfeiture of options. Okay, probability assessment at grant date. So as on the grant date, the condition is deemed not to be probable. So based on the information that is there on the grant date, the management estimates that we will not meet the condition. We will not meet the vesting condition. And if that is the case, then the grant date fair value is ₹8 per share option. Okay. Change in probability assessment. During year 3, market share is projected to be 30% at the end of 4 years. And hence performance condition is now deemed to be probable of achievement. So year 1, not probable. Year 2, not probable. Year 3 and year 4, it is probable it will even vest. So you are going to do this question. Small question it is. Okay, should not take much time. Calculation of EBE. 4 years. Year 1, year 2. Year 3, year 4. So this is number of options, 25,000. into forfeiture. Adjustment. So 8% expected to forfeit. So 92% will be there. So 25,000 into 92%, that gives you, I guess, 23,000 options multiplied by fair value. कितना है fair value? Rupees 8. 8, 8, 8, 8. Okay. Total EBE in rupees. First year, this is not expected to be met. So therefore, EBE for the first year is nil. For the second year also, it will be nil. Into pro rata, that gives you EBE till date less previously recognized. Rupees. So EBE for current year. Okay. All right. Now, pro rata does not make sense here. Not applicable, not applicable. Nil, 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 nil. In the third year, suddenly you did very well, and then you thought now you will meet the condition. So 25,000 into 92% into 8. So that gives you 1,84,000. You expect to meet the condition by the fourth year. So into 3 by 4. So that takes care of it. So 1,38,000. This is 0. So EBE for the third year is 1,38,000. And here 1,84,000, 4 by 4, 1,84,000, 138. So this gives you 46,000. This gives you 46,000. Is it okay? Yes. Any doubts? Entry is clear. EBE account debit to SBP reserve. EBE account debit to SBP reserve. Okay, so this question I have done for you. All right. Okay. All right. So what I will do now is, see, I have completed the questions that relate to non-market linked performance conditions. Market linked performance conditions is another item which is there, but uska treatment is quite simple. So I will come to that towards the later part of this lecture. Okay. When I'm almost closing the session, at that point of time, we will look at it, because that is not very difficult. Okay. Or usme it's not, there is just a small concept which will take hardly a couple of minutes for me to explain. Okay. Forfeiture means departure of employees. You can take it that way. Okay. Here they've not given the number of employees. So forfeited means you can take it that these employees are not eligible. These options are gone. Okay. These options are forfeited. So you can take it as departure. Okay. So now I will just postpone that market link performance condition, because that is easy. Okay. I want to do something that is novel and something that is a little bit different for you, so that you know, we can come back to this concept at a later stage. Okay. So we have done so far share based payments, that is equity settled share based payments. Jay Srivastav, I was expecting this question from one of you. 3/4 or 1/2? Okay, so Jay is asking, sir, we estimated 0. I mean, it is not vesting in year 1. It is not vesting in year 2. But in year 3, it is vesting. So Jay is asking, considering that the probability of vesting happens in year 3 and year 4, should we not take it as 1.1/2 and 2/2? This is what is his question. In fact, I was thinking about it today morning only before the session, and I'm so happy that he has asked it. Okay, you cannot take it as 1/2 and 2/2. Reason is, this is a performance linked. This is a non-market performance linked condition. That means your employees are actually striving their efforts even in years 1 and 2. They are actually putting their efforts in years 1 and 2, in this case, to increase the market share of the product. Dekho, overnight it will not increase to 30% in year 3. There are efforts in year 1 and 2. The only thing is, these efforts are not visible. So if I have to just give an example, forgive me for this example, but I mean, I cannot resist myself. Okay. The viewership of these LCC is not very high. Okay. It's not very high. It may be high later. Okay. It may become high later. Okay. See, the viewership for foundation is very high. It's a good number. The viewership for intermediate right now is not much. The viewership for final CA presently is not that great. Okay. But you cannot tell that the institute has not done any achievement. Now, suppose hypothetically, okay, this is just a fiction. Please don't hold me at gunpoint and say, sir told us. Okay. Let us assume, I'm not an employee, but I'm just giving an example. Let us assume that ICAI gives me options. Okay. That if the strength of viewership touches a particular number after 5 years, then the options will vest in you. In year 1, year 2, that is at the end of the 6th LCC batch, for example, ICI tells me if your viewership touches a particular number, yeah, fictitious, but this will make things clear to you. Then at that point of time, options will vest in you. My first 2 to 3 LCC batches, the viewership is just about average. So the institute will think iska viewership will not reach. But I'm actually working for the 4 to 5 batches. Yes or no? And therefore, you cannot say that this is gone, and in year 5 and 6, you cannot say only 2 years the faculty has put in the efforts. In fact, the viewership may tend to increase in the future because the foundation students who are now giving a good viewership will come to final CA or intermediate by the time your LCC batch number 5, LCC batch number 6 is going on. The LCC batch 5 and 6 viewership count is a result of the efforts put in LCC batch 1, 2, 3, 4. So therefore, you cannot just say that the efforts were put in batch 5 and 6. So we will do 1/2. वो नहीं कर सकते आप. The LCC batches have been running for 6 batches. So it has to be 1, 6, 2, 6, 3, 6. If I put the same analogy in this case, the employees are putting their efforts over 4 years. The efforts are not visible in years 1 and 2 does not mean they've not worked for it. So it is 1/4, 2/4 in years 1 and 2. In year 3, it is 3/4. Now it is visible. So therefore you will book 75% of the expense. And in year 4, you will book the entire expense. Is it okay? So therefore, though it's not visible, the management has taken a kind of a approach where it will not vest at all. In year 3, you have to book it. It's all a game of estimates in days 102. Okay. So Jay, I hope you understood that part. Okay. Please take it as a fictitious example. Okay. Please. All right. I thought that could be the best way I could communicate. Okay. So that is a fictitious example, but nonetheless. Okay. I hope it clarifies the doubt for you. Okay. Now, coming to the next one. Okay. See, so far we have seen ESOPs. What is ESOPs? Sir, employee stock option plan. That means what do you get at the end? Sir, you give shares to your employees. Okay. Now, the other option that we saw was SARs. What is SARs? Sir, share appreciation rights or stock appreciation rights. What does it mean? Sir, you give cash for the increase in the market price of the shares to the holder of the SARs. So this is cash for shares. That means this is equity. This is a financial liability. This is a financial liability. Okay. So now it was either this or this so far what we have studied. Now the question is, can these two things be integrated? Can these two things be integrated? Sir, what do you mean by integrated? Can I give an instrument to my employees or any other person? This is a share-based payment. It's not employee share-based payment. This is a share-based payment. Now, this share-based payment which I'm going to give, can I give an instrument such that the holder of the instrument has the option to choose whether I go for a share appreciation right? That is, whether I can demand, whether the employee says, I want cash at the end of the period, or he also has an option to go for equity of the company. Can you do that, sir? Can we issue an instrument like that? Answer is definitely you can. See, you guys would be studying Ind AS 109 or would have studied 109, where there is a concept of compound financial instruments, where you have instruments like convertible debentures, debentures convertible at the option of the holder, debentures convertible to equity at the option of the issuer. It's not mandatorily convertible. It is optionally convertible. So in this case also, we are going to issue an instrument to my employees or others as a part of a share-based payment plan, and this instrument entitles the holder to choose between whether they want cash at the end of the period or whether they want equity at the end of the period. Both the options. So what we call this as, we call it as a share-based payment option with cash alternatives, and this is exactly the question that we have in the December 2021 examination. Okay, in the December 21 exam we had this question. So it is a share-based payment with a cash alternative. Now what I will do is I will explain the concept along with the example that is there in your study module, the illustration, so that for simplicity's sake and clarity's sake also, you should be able to understand it well. Okay. So now, yes. So now we come to this question, illustration 6. I will explain the concept through the help of this illustration, and then you should be very much clear with that. Okay. Tata Industries issues a share-based option to one of its key management personnel, it should be SONNEL, which can be exercised either in cash or equity, and it has the following features. So what are the features? Option 1, he can go for a cash settled share. That means what? Option 1 is a SAR. He can go for a stock appreciation right, in which case he's going to get what? He's going to get cash for that. He's going to get cash for that. Okay. Now the second option is he is going to get equity settled shares. So this is an equity settled plan. The same instrument, but the option is now there with the key management personnel. Okay. Conditions are what? You have to serve for 3 years. So this is your vesting condition. Okay. So this is for prorating. There is a restriction to sell the equity. You have to, that means when the managerial personnel gets the equity, if he suppose goes for the equity option, then he will have to hold on to that equity for 2 years. He cannot part with it for a period of 2 years. And that is what is known as restrictions, equity option with restrictions. And you are given the fair values. Sir, what are the fair values which are given to you? You are given equity price with a restriction of sale for 2 years, 115. Fair value at the grant date is given to you. This is without restrictions. Fair value as on 20x0 is given, 20x1 is given, 20x2 is given. And with this, you will have to pass the journal entries. You will have to pass the journal entries. Okay, fine. All right. And now let us try to understand this question. So there is Tata Industries. Tata Industries has given an option to one key managerial personnel. How many, what are the options that the KMP has? Well, he can opt for 74,000. He can opt for 74,000 stock appreciation rights. Okay. Or he can opt for 90,000 equity settled shares. 90,000 shares. So here this is cash equivalent to 74,000 SARs and shares equivalent to 90,000. All right. And now the question is, how do I do the accounting for it? How do I do the accounting for it? Sir, you may answer it like this. Sir, he is opting for ESOP. So let us treat it as an ESOP. So 90,000 shares is there. Fair value on the grant date is there. Do the accounting as a share-based payment reserve and account for it. हाँ वो कर सकते हो, but suppose at the end of the period when the right to exercise comes and if he asks for cash and not shares, then what are you going to do? You have accounted for the plan taking it to be an ESOP, but Are bhai, ultimately he asked for cash, and when he asked for cash in your books, financial liability is not there at all. And when financial liability is not there, suddenly he asked for cash. How do you say your books have given a true and fair view in respect of the accounting that you have done in the vesting period? It is not giving a true and fair view. Acha, to fir sir, what we will do is, we will be conservative. We will account for it as a financial liability. Okay, so you proceed with the accounting as a financial liability. You are given the fair value at the end of each reporting period. Okay. Sir, उठ के tomorrow the employee demands मेरे को equity share दे दो. You give me the equity share. I do not want your cash. Again, you are falling into a trap. Now you have a financial liability, but there is no SBP reserve in your balance sheet. So the reader of financial statements will be confused and he will say, yeah, for so many years SBP reserve was not there. There was a financial liability. Now suddenly, how do you have equity shares coming into the picture? How do you have ESOPs coming into the picture when there was no SBP reserve so far? And therefore, we cannot do the accounting as a standalone SAR or as a standalone ESOP. We have to do it as a combination. We have to treat it as a compound instrument. We will have to treat it as a compound instrument, or what we call as a hybrid instrument. What we call as a hybrid instrument. The question is, how do we do that? Okay. One question should arise in your mind. Sir, SARs is 74,000 in number. Shares is 90,000. Sir, employee is the same fellow, right? He is giving the same service. Dekho, he wants SARs at the end of the year, or he wants shares at the end of the vesting period. Banda to ek hi hai. He is the only person. Do you think he will do extra work if he wants shares? Or do you think he will do less work if he wants SARs? No, sir. Aisa to nahi hai. Then why is there a difference between these two things? Either you give 90,000 shares, or 90,000 SARs. No, why are you giving 74 SARs vis-a-vis 90,000 shares? Banda to ek hi hai, doing the same work. Person is only one. Because these shares are restrictive. These shares are restrictive. Restrictive means what? Restrictive means there is a cap on the ability to sell it. Once the KMP exercises the option to convert it into shares, he cannot sell those shares for 2 years. Abhi, because of that cap, because of that restriction, the equity option appears to be a little less desirable. The equity option appears to be a little less desirable. And as a result, the management gives the KMP more number of shares because they want to attract him to exercise the shares option. So they say, you go for SARs, we will give you 74,000. You go for shares, we will give you 90,000. Okay. Now these shares have a fair value of rupees 115. It is given in the question. Equity price with a restriction of 2 years. So what is the fair value of the equity option? Therefore, total fair value is 90,000 into 115. So this is 1,350,000. 1,350,000. That means he is having the option to get shares worth 1,350,000 at the grant date. Okay, at the end of the vesting period. Sir, let us compare that with SARs. What is the fair value on the grant date? SARs are free. That means you get the cash, you can do whatever you want with the cash. So in that sense, the SARs do not have any restriction. So therefore, the fair value at the grant date is 135. So rupees 135. Therefore, what is your total fair value here? Your total fair value is 74,000 into 135. That is 99,90,000. 99,90,000. Now, you cannot, I repeat, you cannot account for it as a SAR. Because tomorrow he can wake up and say that I want equity. Okay, so you cannot treat it as purely a SAR. You cannot treat it as purely an equity. You will have to treat it as a combo offer. You will have to treat it as a combo offer. The shares have a fair value of 1,350,000 shares. The SARs have an option value of 99,90,000. The incremental value is regarded as the value of the equity option. Therefore, value of equity option is equal to 1,350,000 minus 99,90,000. So that gives you how much? 3,60,000. That means, how will I view this plan now? I will view this plan as the plan is viewed as SARs with fair value of rupees 99,90,000 plus equity option of rupees 3,60,000. This is how you are going to view this particular plan. 99,90,000, you will do the accounting as if it is a share appreciation right. Equity option, you will treat it as an equity option and you will do the accounting in a combined manner. You have to do it like this. Dekho, let us take a scenario where you have Reliance Industries Limited. Reliance Industries also on similar terms gives to its KMP cash SARs having a fair value of rupees 135. Total fair value, same thing. Everything is exactly the same. Rupees 99,90,000. Now, between the instruments given by Tata and given by Reliance, whose instrument is more valuable? Think and tell me whose instrument is more valuable. The one which is given by Tata has a SARs option with the option to go for equity also, whereas Reliance Industries gives the same SARs options, SARs awards to its key managerial personnel. So between Tata and Reliance, now you tell me whose option in this case is more reliable. Okay, just think and answer. And why? And why? Okay, think and answer and tell me why it is more reliable. Okay, it is hypothetical. They use Tata, that is why I used Reliance. Okay, so now you tell me which one appears to be more valuable, or do you say sir dono ka value ek hi hai? What do you guys think? Whose instrument is more valuable? Whose instrument is ideally more valuable? Obviously, it is Tata's instrument. Forget all these calculations. If you are a KMP in Tata, you have the option to take cash whenever you want, or you have the option to take equity whenever you want. Okay, when in the exercise period. Against that, Reliance says, I do not want to give equity to my KMP. I will give him only SARs. Matlab, I will give him only cash. So obviously, from that reasoning also, you have to come to the conclusion that Tata Industries instrument is definitely more valuable per se as compared to Reliance Industries. And when that is more valuable, that higher value should be reflected in your accounting, no? When that higher value will be reflected, when you show this equity option, when you show this equity option of 3,60,000. Okay, so you will take it as a cash plan with equity settled option. Yes, that's right. So Jay is saying because the equity option is the additional benefit if the price increases for Tata. That's absolutely right. So therefore, this plan is more valuable to you. Okay, and that is why we will account for this as a SAR, but even giving effect to the equity option, even giving effect to the equity option. So now, what is the journal entry that you will pass? How are you going to pass it? Okay, so now let us just prepare a table. Calculation of EBE. Okay, copy this down please, or take a screenshot and then let me know. Okay. In future, dividends will also come, share price will also increase. So obviously, yes, that's right. Okay, so if you have taken a screenshot, I will then proceed further. So now we have two plans with us. One is the cash plan with a fair value of 99,90,000. The other is the equity option of 3,60,000. We will account for it separately. Okay, I mean we'll show that in our accounting. Okay, so calculation of EBE in respect of cash plan. How many years vesting Tata Industries has given, which can be exercised? 3 years value is given, so we will take 3 years vesting. Okay, 20 X0 X1 X2. X2. Okay. Acha, done. All right. So now here, number of employees, your usual table, 1 into number of SARs per employee. How many SARs do I have? 74,000. 74,000. 74,000 multiplied by fair value. Remember, this is a SAR and therefore the fair value changes have to be considered. So 138, 140, 147. 138, 140, 147. Okay. So what is going to be your total? Therefore, total EBE in rupees comes to how much? 74,000 into 138. 1,212,000 into 140, 1,360,000 and 74,000, 1,878,000. Total EBE into pro rata. Vesting 3 years, so 1 by 3, 2 by 3, 3 by 3. So that is going to give you EBE till date. So 1,212,000 divided by 3. 34,04,000. 103,60,000 into 2 by 3. 69,06,667. And finally 1,08,78,000 less recognized earlier. Sir, this is 0. So EBE for current year, this is 34,04,000. Here you take 34,04,000. So 69,06,667. 35,02,667. $39,71,333. All right. So EBE for current year is this in the case of cash plan. We now move to equity option. Equity option. X0, X1, X2. One employee into fair value of option. Already you have calculated this figure, 3,60,000. So 3,60,000 3,60,000, 3,60,000. Total EBE rupees 3,60,000, 3,60,000, 3,60,000 into pro rata 1/3, 2/3, 3/3. So that gives you EBE till date 1,20,000, 1,20,000. Sorry, this is not 1,20,000. This will be 2,40,000, 3,60,000. Less earlier recognized nil 1,20,000, 2,40,000. So this is 1,20,000, 1,20,000, 1,20,000. What is this? EBE for current year. EBE for current year. Okay. Have you understood these two things? Yes or no? Have you understood these two calculations? See, calculations are the very same. Usme there is no difference at all. The only thing is what you have to understand is there is a cash plan on one side, there is an equity option on the other. You have to somehow bring the equity option in your workings. Okay. You have to somehow bring the equity option in your workings. So wo aapko dikhana padega. You will have to show that. Okay. In this case, it is 3,60,000. In this case, it is 3,60,000. Done? Any doubt so far? Vidula is there. Good to see you. I still have a couple of concepts to discuss. Okay. So if you are copying, good. If you are okay with the taking of screenshots, that is also fine. So in this online class, efforts are more on your side also. Okay. Conservative approach is followed since liability is recognized. Yes, we have to be conservative. At the same time, we cannot ignore equity also. You cannot say I will only record liability. Okay, wo to fir it is not making sense, right? You have to be conservative, but at the same time, please do show that yes, there is an equity element also. There is an equity element also. Okay. All right. So now we pass the journal entries for this. My EBE is going to be 34,04,000 plus 1,20,000, 35,02,000 plus 1,20,000, 39,71,333 plus 1,20,000. And then we will see what will be the impact when the employee either selects the cash plan, I mean the SARs for exercising, or when he goes for equity, what will be the impact on that? Okay, so let us move on to the next one, journal entries. December, right? Calendar year, yes, so it will be December. So the entry will be EBE account. Why do I do this? I can easily take it as EBE, which goes to the P&L account debit to SBP liability to SBP reserve. Baba, reserve to every year it is 1,20,000 straightforward, because we don't do fair valuation of reserve. So 1,20,000. How much is your cash plan? EBE 34 lakh 4, 35 lakh 2, 667. 34 lakh 4, 35 lakh 2,667. And then 3971 333. So what will be your EBE? In the first case, 35 lakh 24,000. In the second case, 3622 667. And in the last case, 3940 40 lakh 91,000 333. Sir, is this accounting as per financial? This is as per 102. This is as per 102. But we have borrowed the concept that financial liability should be fair valued from 109. Okay. So SAR valuation at the end of every reporting period 109 is, at the end of every reporting period, fair value that is taken from 109. It's mentioned here, but the source of that is 109, because a SAR is a financial liability. It is an obligation to deliver cash. So therefore it has to follow financial instrument principles. Likewise, this also. Okay. Technically this also. Okay. But how do I split? This is given in 102. Okay, so these are your journal entries for recording the EBE. So balance on 31/12/20 SBP liability. How much is it? SBP liability balance is 1,08,78,000 credit, and SBP reserve is 3,60,000 credit. SBP reserve is 3,60,000 credit. And now we move on to exercise. So now it is the last day, and now it is time for the employee, the KMP, to exercise. So suppose he applies for the cash alternative. So as on that day, you will have to pay him the cash. How much cash will you pay? 1,08,78,000. SBP liability debit 1,08,78,000 to bank. 1,08,78,000. Yes. How do I get this value? 74,000 SARs multiplied by the value 147. Fair value, there is no exercise price details given. So intrinsic value we cannot find out. So as of now, just multiply it by 147, assuming there is no exercise price. So jitna value hai, you are going to get that value. Okay. And now the options are exercised. You cannot keep SBP reserve. So you will have to transfer it to retained earnings. SBP reserve debit to retained earnings. Entire balance of 3,60,000 3,60,000. 3,60,000. Okay. 311220x2 if you go for equity alternative. Now you will tell, sir, I don't need cash. I want equity for my instruments. So the face value is not given, right? Face value is not given. Let us assume it is 100. So therefore, what is the entry that you will pass? First thing, liability will go. SBP liability debit. Sir, why it will go? Because you are avoiding this cash outflow. No, as the reporting entity, the person to whom you have given the instrument wants equity. So that means this liability is not going to be paid, or it will be settled into equity. So SBP liability account debit 1,08,78,000. SBP reserve account debit 3,60,000 to equity share capital 90,000 shares into rupees 100. So this gives you 90 lakhs. And then to securities premium. To securities premium 22,38,000. Assuming face value is equal to rupees 100. Assuming face value is equal to rupees 100. Done? Have you guys understood this? So you conservatively account for it first as a liability and record the equity option also. Record the equity option also. Have you guys understood? Have you guys understood? Fair value equals SBP reserve is 3,60,000, but equity capital is 90 lakhs. Will it not raise an audit query? Well, it will raise, but you can explain it that the KMP has opted to convert his options into equity, and that is why, see, you are seeing only an SBP reserve of 3,60,000, but you should also see the SBP liability along with that. When he exercises the equity option, he is in effect avoiding, or he is in effect surrendering the liability. Okay, so you can take it as liability surrendered. So this is also, if I have to think it in intermediate terms, it is as if this liability is getting converted into equity capital. Yes or no? So you cannot just say that reserve is 3,60,000 and therefore how can you have an equity capital of 90 lakhs? It's not just equity option, right? The bulk is a SAR option. you have to understand that when he opts for equity, he's not going to get cash. So that liability has to be wiped out from your books. And how will you wipe out? By debiting and crediting the equity capital. So that should not create any issue. Okay. I'll upload this, Srinidhi. I'll upload these notes. Okay. The fair value equals intrinsic value on exercise date if it is not given in the question. Yes, typically that is there. You can take that. Okay. They will have to mention the exercise price. Normally, even intrinsic values, they don't mention. Okay. I'm very honest with you. Intrinsic value ka concept is no longer there. Okay. So intrinsic value, they will not give. They will just give this much value will be paid in the case of a SAR. Okay. So that is how you will have to treat that. Okay. So that kind of completes this. Now I will just modify this question a little bit. Okay. We've done this question, but suppose instead of 90,000 shares, the option was, I'm going to give the KMP 74,000 SARs or 80,000 shares with restrictive rights, with restrictive option. What is restriction? You have to hold it. So what will be the total fair value now? The total fair value of this is going to be 80,000 into 115, 92 lakhs. 92 lakhs. And now when it is 92 lakhs, the equity plan value, I'm writing it here. Equity plan value is, this is the modified question. Okay. 80,000 into 115. So 92 lakhs. And cash plan is 99 lakh 90,000. So there is a negative 7 lakh 90,000. A negative 7 lakh 90,000 means, a negative 7 lakh 90,000 means the equity option is worthless. The equity option is in effect worthless. Worthless means uska koi value hi nahi hai. The employee will say, dekho, you've given me an option to take the equity, but that option is so useless that I will not exercise it at all. On the grant date itself, you will say, you are expecting me to go for equity where I'm going to lose 7 lakh 90,000 rupees. Do you think I will really exercise your equity option? Aapne diya to diya, that is fine. But for me, it is a useless option. I will never exercise that option. I will always go for the cash conversion. So when you have this kind of a scenario where the equity option is useless, it means that the value of equity is to be taken as 0. Value of equity is to be taken as 0 and record this plan as a pure stock appreciation right plan, because he will not exercise it. Option to diya hai, dene ke liye give at least a good option, right? You cannot give an option where one option is worthless, then nobody will exercise that. So at that point of time, if this turns negative, you don't have a question so far, but suppose in future, I'm just telling you, if it turns negative, then you go for recording it as a pure stock appreciation rights. You will have to record it as a pure stock appreciation right. Option ka value will never be negative. You have to understand that option value will never be negative. Suppose you have a call option to purchase shares. Okay. You have a call option to purchase shares for 100 rupees. The share is trading at 110 in the market. So you will obviously exercise the option, buy a share for 100, sell it in the market for 110. The value of that option for you is 10 rupees. Right? Today the value is 10 rupees. Suppose you have a call option for 100 and the share is trading at 90 or 95, for example. It means you will not exercise the option in the first place. So for you, you cannot say value of my option is -5. You cannot say I will exercise 100, pay 100, get the share and sell it for 95. You cannot say my option is -5. Because आप उसको exercise ही नहीं करोगे, you will not exercise that option. And when you don't exercise that piece of paper, which is that option, that value is 0 for you. So ultimately, the same reasoning applies here. You have given him on paper equity shares, but it is useless for him. He will go for the cash alternative only. So in this case, when it becomes negative, how are you going to record it? You will record it as a pure SAR plan. You will record it as a pure stock appreciation rights plan. Okay. So that completes this topic. Okay. I have done this question for you. Okay. I will want you to do this question as homework. Same things are there. Share alternative fair value is given. Grant date fair value is given. Fair value on December X1, X2 is given. So this is 2 years. We have done for 3 years. So I don't think you should have any difficulty. Okay. And then you can look at this example also. Same treatment is there. Okay. Same treatment is there. Expense, equity, liability. See, equity is equally divided. Okay. Whereas this liability is 1/3, 2/3 minus previously recognized, 3/3 minus previously recognized. So when you read this, you can do it for homework. Okay. It's all done for you. This one also, you can do it for homework. Okay. Ambani grants its CEO an option to take either cash amount equivalent to 800 or 990 shares. The minimum service requirement is 2 years. There is a condition to keep the shares for 3 years if the shares are opted. So you will have to check this out. You will have to check this out. Okay. It is a restrictive option. So now what are you going to do? The value of the equity option is 990 shares into what is the fair value? 212. And here cash option is 800 into 213. So 990 into 212. You can take it as 209,880. And this is 800 into 213. 170,400. 209,880, 170,400. 39,480 is the value of your equity option, and accordingly you will have to solve it. Accordingly you will have to solve it. Okay, so this also for homework, and this is exactly the question I was going through the December 2021 paper, right? And because I got a query from one of the students that please solve the December 21 paper. This is exactly, I repeat, it is exactly the same as this question. Okay. Khali figures different. Question 4B, December 2021 paper. Okay. 6 marks. Exactly the same. Okay. उसमें खाली नाम अलग है, थोड़े बहुत फिगर्स अलग है, but I think you should do this and try it out. Okay, you should do this and try it out. Okay, I can just help you with the initial figures. Georgie limit, the question is not there here. Okay, so Georgie gave its key management option to take 810 shares or cash amount equivalent to 65 SARs. So what is the fair value of this? 810 into 460, and this is 480. Okay. So now when you take this 810 into 460, 372, 600. This is the December 21 question. Okay. 3,12,000. So 60,600 is the value of the equity option. Okay. And then you do the accounting. This is December 21. All right. So you can read the question and do it. It's not much of an effort for you. Okay. Since restrictions are there, will it increase the vesting by 2 years? No, it is restriction to sell, Jay. Okay. Options will be vested in you, but you cannot sell the shares the moment you exercise them. You have to hold on it for 2 years. Okay. So that is the meaning of restrictions. Vesting won't increase. Okay. All right. So that takes care of cash settled what you call SBPTs with cash alternatives, and the theory is given to you. So you please go through that. You should understand it. Okay. One more small concept. Now all the small concepts are there. I will cover that quickly for you. So accounting for SBPTs among group entities. Okay. See, we have a group. What is a group? A parent and a subsidiary. Okay. Now we have a listed parent company. So let me say this is Reliance Industries Limited. Okay. We have an unlisted subsidiary. Let us say Geo Platforms. Okay. We have an unlisted subsidiary, Geo Platforms. Employees are working for Geo Platforms. Okay. So Ind AS 102 is applicable to the recipient of goods. Okay. So unlisted subsidiary Geo Platforms is getting the service of employees. Geo Platforms wants to give a stock option plan to the employees, to its employees. Employees बोलेंगे, sir, आप हमको Jio के shares दोगे. You will give me Jio's shares, but what will I do with Jio's shares? It will only lie there with me. I'll not be able to sell it anywhere because Jio Platforms is an unlisted company. And since it is unlisted, for the sake of giving, you are giving. Uska real value is not there with me. Instead, please check if you can give us Reliance Industries shares, the parent company shares. Subsidiary bolega, theek hai, you want Reliance shares, right? I will give you Reliance company shares. So now service is given to Jio, but equity shares are being issued by H Limited. Okay. So what is happening is Reliance Industries issues shares. Jio's employees are giving it the services. So issue shares to employees of Jio. Now the question arises, sir, who has to recognize? Reliance Industries Limited ke books mein, I will credit equity share capital. I will credit equity share capital because it is actually issuing the shares. Jio is actually getting the services. So in Jio's books, I will actually debit employee benefit expense account debit. The question is, to whom am I going to, what am I going to credit? What Reliance, that is the holding company, will debit? What will Jio credit? Jio cannot credit equity capital because Jio is not issuing shares. Reliance Industries cannot debit EB because Reliance Industries is not getting the services. So what are you going to do? If you view from a group perspective, from a group perspective, services are provided to that group and shares are issued by that group. But when I view on a standalone basis, this issue arises. And therefore, what the standard tells? The standard tells you will have to treat this as if Reliance has made an investment in Jio. As if Reliance has made an investment in Jio. It is increasing its equity capital. Why? To invest in Jio. All right. It is as if you are saying, dekho, let me simplify this. Jio has to pay salary to its employees. Jio has to pay salary to its employees. Jio does not have the money. Jio does not have the money. So what Jio will do? Jio will ask parent, please give me money to pay salary to my employees. Reliance will say, why you want money? I don't have money. So many years I gave discounted plan, free recharge, free internet, everything free. Now I don't have the money. You have to pay me you have to give me cash to pay my employees. So Reliance Industries will say, beta, giving you money is as if I'm giving to my, what you can say, subsidiary. You take the money. There is no restriction on, or there is no compulsion for you to return because we are all part of the same group. So Reliance Industries gives cash to Jio. Jio pays that cash as salaries. Now, there is no obligation between Reliance and Jio to repay this amount back. That means what? In effect, Reliance has kind of made an investment in Jio. Jio may not issue shares, doesn't matter. Look at the substance of the transaction. Reliance put cash in Jio because Reliance wants the employees of Jio to continue in Jio, because Reliance believes that Jio's profits will arise in the future. That point of time, it can draw the cash in the form of dividends. But right now, Reliance Industries is making an investment in Jio. So though it appears that Reliance is giving cash advance, substance of the transaction is it is nothing but an investment. In this case also, it is nothing but an investment which is being made. Only thing is, this is not a cash investment. This is an investment in kind. Kind bole to, what do you mean by kind? I'm giving my equity shares. Why are you giving equity shares? Because Jio's employees want ESOP. So therefore, I will give my equity shares. So investment in Jio account debit to equity share capital. And what Jio will pass? Jio will pass the entry EBE account debit to capital contribution. Capital contribution from Reliance Industries. Okay, this is the entry which is going to be passed. When where will this sit? Sir, this will go and sit in other equity in the standalone balance sheet. And in the case of investment in Jio, that will be a part of its long-term investment. Sir, this is standalone. Consolidation ke time pe, when you consolidate, these items will be cancelled. In CFS, investment in Jio will cancel capital contribution. That's it. As simple as that. Investment in Jio will cancel the capital contribution from Reliance Industries. And you will have a net EBE on the debit side and equity share capital on the credit side. So as simple as that. Now you move to the next case. Sir, can the other case also happen? Sir, example, I have a parent company, Tata Sons. Tata Sons has a subsidiary, TCS. Tata Sons is unlisted. TCS is listed. Tata Sons wants to issue ESOPs to its employees. Again, Tata Sons employees will say, sir, giving us ESOPs is like giving us nothing, because we cannot sell the shares anywhere. We will ultimately come back to you and say, take the shares and give us the money. It will be nice if you give us shares of TCS or any other listed company. Okay, Tata Motors, vagera, vagera, vagera. Okay. So now if that is the scenario, then what Tata Sons will do? Tata Sons in this case is getting employee benefit expense, and TCS is giving equity shares to its employees. So what will be the journal entry? The journal entry will be, in the case of Tata Sons, it is getting the service from employees. So here EBE account debit. EBE account debit. Okay. And in the case of TCS is issuing equity shares. So to equity share capital. The question is, what will Tata Sons credit? It cannot credit equity share capital because Tata is not issuing shares. TCS cannot debit employee benefit expense because it is not receiving the service. It is expenditure of the parent, repaid, paid by the subsidiary. So what is this? This is as if TCS is distributing the profits to Tata Sons. So it is distribution to parent. Transaction between parent and subsidiary. To distribution from TCS. It is as if dividend is being given in kind in the form of equity shares. Okay. So a distribution to parent, distribution from subsidiary. So these two things will appear and they will again cancel out each other in the they will again cancel out each other in the consolidated financial statements. So that is all that is there in SBPTs among group entities. Fairly simple. There are 2-3 small questions which are not at all difficult. So I think you should be able to do them. Okay, I'm leaving this for homework. I'm of course accessible, but I think you should be able to do it. Now coming back to 3-4 small concepts are there before I close the session. Modifications. 1 second. Share paste. Let me just check up. Where is the question? I had noted the slide numbers. Okay, 62. Okay. Modification of ESOPs. The question is, sir, can ESOPs be modified? Modified means what? We have already seen one modification in today's class. Which modification? Vesting period decreased from 4 years to 3 years or 3 years to 2 years. We did it in today's class. So modification of tenure we have already seen. But sir, can exercise price be modified? It can be modified. Okay. You can say that initially when you introduced the plan, the exercise price was 100 rupees. Later on, as you progressed, you found that employees are working really well. So instead of 100 rupees, I will collect 80 rupees. Okay. So you are repricing the options. Repricing the options. Okay. What do you mean by repricing? Initial exercise price. And on the other hand, I have fair value. So on grant date, the exercise price was 100. And when the exercise price was 100, let us assume that the fair value was 15. This is the value of the option. Distribution, okay. See, Jay, in the case of subsidiary, you cannot have a subsidiary making an investment in a parent. वो थोड़ा सा it appears to be off track. Parent can invest in the subsidiary, but can subsidiary invest in the parent? That is a little far-fetched. Okay, so it is like saying when you are dependent on your parents, you get money from them. But when you return that money back to them, it does not mean you are investing in them, right? It is just a return that you are giving back to them. Okay, so therefore you will cancel it out. Okay, in SFS, capital contribution and investment will come forever. Uska kuch nahi kar sakte because it is SFS and this is a permanent investment which you have made. It is a permanent investment. So yes, in SFS it will go on continuing forever. Okay, it will go on continuing forever. All right, but subsidiary issuing equity shares to employees of the parent, it generally does not fit with the understanding that subsidiary can invest in the parent. So that is why we take it as distribution. Okay, Jay. So I hope that it is understood. I'm happy there is one student who is asking questions. Okay. So now coming to modification of ESOPs, exercise price on the grant date is 100 and the fair value was 15. Suppose 2 years later, you think that our employees are working well. Why do I have to make them give 100? Let me modify it to 80. Let me modify it to 80. And when you modify it to 80, the fair value increases to say 35. Just ad hoc examples. Obviously, no, from the market perspective, when you bring down the exercise price, your option becomes more valuable. Why valuable? Because more employees will prefer it. It starts to get it starts to become a more precious item right now. And therefore, the fair value of that option goes up. The fair value of that option goes up. This is what is known as modifying the option. This is what is known as modifying the option. In effect, by increasing the fair value, the employer company, that is the reporting entity, is doing something extra for its employees. It is doing something extra for its employees. And therefore, you will have to record that modification. You will have to record that modification. Sir, modifications which result in reduction in fair value. For example, not 80, I will make it as 125. As a result, my option value is now 10 rupees. Will I recognize this option? Answer is no, you will not. Because this option is detrimental to the employee. This option is detrimental to the employee, and the standard says you will record only those modifications which are beneficial. Options which are detrimental will not be taken by the employees. What is the presumption? So the value of that is technically 0, and therefore options detrimental to the employee will not be recognized. Acha, how do I account for this? Well, you will account for it like this. Old plan, continue to account as it is. No change. So what was the fair value on grant date? What are your estimates? What are your pro rata? Everything is exactly the same as you were doing. Do not change that. Continue to account as it is. No change. Modification. Record as a new plan from the date of modification. So as if you think that a new plan is entered, and this new plan will have its own grant date, it will have its own fair value, it will have its own pro rata period. So you record it as if it is a new plan. You record it as if it is a new plan. So what it will have? It will have its own grant date, which is nothing but date of modification. You will have the fair value, which is what we call as, incremental fair value. We are accounting as if it is a new plan, but in reality, is it a new plan? Answer is no, it's not. It is a continuation of existing plan. Because of modification, that plan has become more valuable, and you want to recognize those expenses which made the plan more valuable. How will you recognize? By calculating something known as incremental fair value. What do you mean by incremental fair value? Fair value of old plan on modification date. Fair value of old plan on modification date minus fair value of modified plan on modification date. Fair value of modified plan on modification date. It is as if you are saying, suppose you are working for a company like Tanishq. Okay. Suppose you are working for a company like Tanishq. Tanishq says at the end of 3 years service, I am going to give you, at the end of 5 years service, Tanishq is going to give its employees 10 grams of gold. Okay. So 5 years service, 10 grams of gold. This is the original plan. Now, a modification has come after 3 years. After 3 years, they say, we are going to give you not 10 grams, but we are going to give you 12 grams of gold. 12 grams of gold. So what is the incremental gold that you are getting? Sir, we are getting incremental 2 grams of gold. The 10 grams of gold will be recorded at the original value. There is no change in this. Mind you, there is no change in this. Okay. But 2 grams of gold extra will be recorded on the date of modification. Sir, how will I record it? Well, you will have to take the fair value of the old plan. What is the fair value on date of modification minus fair value of modified plan? What is this on the date of modification? The difference between these two plans for 2 grams of gold is going to be the modification that you are going to account for. Okay. So with this, let us just see a question. I will tell you how to do it. I don't have the time. That is why I'll be a little fast, but these are all simple concepts. Okay. See, Marathon issued 150 share options to each of its 1000 employees, subject to service condition of 3 years. So this is the old plan. Fair value of the option was calculated at rupees 29. Old plan, fair value on grant date is equal to 129. Below are the details and activities related to the share-based payment plan. 35 employees left and further 60 are expected to leave. These are standard adjustments, no change. Share options repriced as market value has fallen. So share options repriced as the fair value fell to 50. After repricing, they are now worth rupees 80. Hence, expense is expected to increase by 30. Okay. So, modification date, fair value of old plan. Okay. Share options repriced. You can check here. Fair value fell to rupees 50. So on this date, it is rupees 50. After the repricing, they are now worth rupees 80. So fair value of revised plan is rupees 80. So what has happened? The fair value, because of revision in pricing, has increased by 30. We call this as incremental fair value. We call this as incremental fair value. Old plan will continue to be recorded at this fair value. There won't be any change to the old plan. There won't be any change to the old plan. Old plan had a life of 3 years. Continue with 3 years. Old plan had a fair value of 129. Continue with 129. Don't change this. The modification is happening. The standard tells view the modification as a different plan. This different plan has an incremental fair value of 30 rupees. And these options are repriced at the end of year 1. That means what is the tenure of the modified plan? The tenure of the modified plan is 2 years. The tenures of the modified plan is 2 years. So you will do the prorating. Prorata will be 1/2 in year 2 and 2/2 in year 3. Okay, 1/2 and 2/2. And old plan, the prorating will be 1/3 in year 1, 2/3 in year 2, and 3/3 in year 3. So this is how you will do the accounting. Calculate incremental fair value. Number of employees in both the plans will remain the same estimate. So that will not change. But what will change is incremental fair value. Sir, are we calculating my fair value? Again, are we revising the fair value? We are not. Remember, old plan continues at 129 rupees. Old plan continues at 129. The modified plan is changing. The modified plan is changing. So this continues at old rates. This continues at old rates. Whereas modification happens now. Modification happens now. And that is why we are not departing from our concept that fair value can change. No, fair value remains 129. It is the modification only which we are taking the incremental fair value. So basis this, you prepare another table for calculating the EBE and add both the EBEs under old plan and the revised plan to arrive at the total employee benefit expense. Okay, so this is how you will do the accounting. Rest all is the same, just this is the concept of modification. SBPA involves only equity, or does it include preference also? Any item of equity. Okay, if preference shares meet the definition of equity shares in terms of financial instruments, you will take it. Okay, but normally if you say preference shares which are redeemable, then in that case you are giving them an instrument for which you are going to get cash. Okay, I mean you are it is as if you are going to give them preference shares are in the nature of a liability. That point of time it will not be considered. Okay, so this takes care of modification. And then we have cancellation of plan. Okay, last two concepts are left. I will explain and close the session. Cancellation of plan. Please go through what all presentation is there, because see, lack of time. I have done the questions, whatever I felt are important, but it is a vast standard. Okay, so I have to kind of depend on you guys, but I'm reachable whenever you want. Okay, I'm reachable whenever you want. So please feel free to what you can say, reach out to me. See, what do you mean by cancellation? Suppose there was an ESOP plan with a life of 3 years. There was an ESOP with a life of 3 years. For some reason, the management cancelled the plan in second year. For some reason, the management cancelled the plan in the second year. So when the management cancels the plan in the second year, how are you going to treat it? First, cancellation of plan means management is breaching the terms of the contract. You have to understand that. This is an ESOP. Employees are there with you because you promised them an ESOP. Terms में लिखा हुआ है, the management, the employees will stay and fulfill the service condition. So they were probably waiting for the ESOPs, but in the second year you are cancelling the plan itself. That means now from the second year, the service condition, performance condition, nothing exists. The employee is free because he is not going to get the ESOPs. So therefore, first thing is, when you talk about cancelled plans, the first thing that you do is accelerate the vesting. Accelerate the vesting. That means what? It is as if the plan which was of 3 years earlier is now already expired in the second year. The plan which was of 3 years earlier has already expired now. So what you would have done, EBE, you would have booked as 1/3 in the first year, and you would have a plan of 2/3 and 3/3 in years 2 and 3, if I'm not mistaken. Okay, but now the plan does not exist only. That means you cannot do a 3/3. Therefore, this is accelerated vesting. You will continue with 1/3. You will continue with 1/3, but in the second year, you will take it as 2/2. Why 2/2? Sir, this option getting cancelled is making my employee free. And because he is getting free, it is as if, substance is as if you made him free. That means you are removing that condition from him. The service condition of 3 years, the vesting period of 3 years, you are removing it from him. And when you are removing the vesting period, it means as if the options have vested. As if the options have vested. I'm not saying options are vested. Options, as if they are vested, you will do the accounting as if the options have vested. So 2/2, you will record the complete EBE of the plan. You will record the complete EBE of the plan. So you will pass the entry EBE account debit to SBP reserve. this entry will be passed for the entire expense in 2 years. In 2 years instead of 3 years. Earlier it was a 2-year expenditure. Now you record it in 3 years and finish it off. Number one. Second, when you cancel an ESOP, you have to pay the compensation to the employees. You have to pay the compensation. Now, how are you going to pay the compensation? You are going to pay the compensation by, paying cash. Okay. So you will give a cash compensation. Now, this cash compensation is as if it appears that an SBP reserve item is being paid in cash form. It is as if an SBP reserve item is being paid in cash form. So how am I going to account for this cash compensation? Two things are there. First thing, up to fair value on date of cancellation. Up to fair value on the date of cancellation, you will adjust it against SBP reserve. You will adjust it against SBP reserve. Why? Because that is the worth of the plan which you are reimbursing back to the employee. This is not something extra which you are giving. You had to give them shares. You've not given them shares. You've in fact cancelled the plan and instead you are paying a cash compensation. So up to the fair value on the date of cancellation, you will adjust it against SBP reserve. Whereas cash compensation in excess of fair value. Sir, this will always be there. You cannot give them fair value of the shares and say, ho gaya, rafa dafa ho jao. You cannot say that. You give them the amount and it's done. You have to give them a compensation. So this in excess of fair value is a loss on compensation. Is a loss on compensation which will be transferred to P&L. Which will be transferred to P&L. Okay. So this is what is your treatment on cancellation. And finally, there will be some balance in SBP reserve. So SBP reserve, any balance left, transfer to retained earnings. Transfer to retained earnings. Okay. So 3 adjustments for cancellation. First adjustment, accelerate the vesting. Why you will accelerate? It is as if you are making the employee free. And therefore, now no vesting condition binds him, no vesting period binds him. So accelerate the vesting, make him free, record the entire EBE. Second, because you have breached the conditions of ESOP, you will pay a cash compensation. Up to the fair value, adjust it against SBP reserve because you are giving what was rightfully due to him. But now you will also pay something extra as a penalty. Okay, this is in the nature of a penalty. Now this penalty, you have to show it separately in the P&L as a loss on compensation. Loss on compensation, which will be transferred to the P&L. Okay, loss on cancellation, sorry, not compensation. Loss on cancellation, which will be transferred to P&L. And after this SBP reserve is adjusted, if there is any balance left, then the third adjustment is you transfer that balance to retained earnings. Because plan is not there, you cannot keep SBP reserves, you transfer that to retained earnings. So this is the treatment of cancellation. Modification ke case mein, what is the treatment? In the case of modification, the treatment is you treat the modified plan as if it is a new plan. 129 will continue to be accounted. 129 minus 50 we are not concerned with. It's nothing for me. Okay. The difference between 50 and 80 will be spread over the remaining vesting term. It will be spread over the remaining vesting term. Old plan continues to be accounted as it is. Okay, so these are two small adjustments which are there, that is cancellation as well as modification. And last part which I was telling you is very simple is last part is modification, sorry, not modification, market linked performance conditions. Market linked performance condition. What do we do? See, non-market linked, what we did, we used to record the expenses based on estimating how much of it will be met in which year. Will I meet the earnings target? Will I meet the growth target? Will I meet the market share? All these things are recorded. However, market linked performance condition means what? Share price will touch a particular level. Share price will reach this level. Share price will grow by 80%. These are all the kind of market linked performance condition. These market linked performance conditions are captured in the fair value on grant date. These are already captured in the fair value on the grant date. And as we told you that whatever is the fair value on grant date, that value cannot be changed in the case of ESOP. And that is why any change in fair value in the case of ESOP is never recognized. Why? We do not remeasure our equity. Now, these conditions were captured when we were doing our fair valuation. You cannot change the fair value. That means any change in market linked conditions also will have to be ignored. It will have to be ignored. Sir, what do you mean by ignored? For example, there is a stock option plan for which requires market price to reach rupees 1000 in to reach rupees 1000 in 5 years. Suppose this is the condition that is there. Now, this market price reaching 1000 in 5 years, this would have been factored when you calculate the fair value on grant date. Fair value on grant date आप जब निकालोगे, you follow binomial model or the Black-Scholes model, which are all based on expected market values. So this fact is already captured in the fair value on the grant date. Now suppose the market price reaches 1000 in 7 years, not 5 years, and you know it is not going to reach in 5 years. What are you going to do? Can you say options will not vest? You cannot say that. The fact of the market price able to reach in 5 years, 7 years, etc., whatever it is, those conditions are included when you were estimating the fair value on the grant date. You are not changing the fair value. So be consistent and do not make an estimate of market conditions again. Fair value up constant rakh rahe ho. You are keeping the fair value constant. That means you keep all the conditions relating to market performance conditions also constant. Do not estimate, re-estimate your values again and again, because that reflects the fact that you are keeping fair value constant, but the conditions relating to that fair value you are changing. How can you do that? Either change the fair value also, change the conditions also, or keep the fair value constant, keep the conditions relating to that fair value constant. So if the market price does not reach 1000 in 5 years, will you say options have not vested? Answer is no, you cannot do that. It will vest in the employees. It will vest in the employees. Why? Because that is factored in the fair value. So you will record 1/5, 2/5, 3/5, 4/5 and 5/5. You will go on recording these expenses in your balance sheet, in your profit and loss account. It may vest in the 7th year. In the 7th year, you meet the market condition. Doesn't matter. the options will vest at the end of 5 years. I am ignoring the market condition. I am ignoring the market condition. Okay. However, there is one small twist to this. Suppose you have met the market condition in the 3rd year. In year 3 only, your options are met. What are you going to do? Met means ESOPs have vested in you. So therefore, year 1, you would have recorded 1/5. Year 2, you would have recorded 2/5. Year 3, the options are already vested. So now you will record 3/3. So how are you going to go about with vesting? How are you going to go about with vesting? If the actual vesting period is longer than the estimated vesting period. First case, 5 years was the estimate, 7 years it took. Okay, this is actual, this is estimate. If actual is greater than estimate, then you will have to spread the EBE over the estimate. You will have to spread EBE over the estimate. Okay, spread EBE over 5 years. Because 7 years, 10 years, kabhi bhi na ho, doesn't matter. It is already captured in the fair value. So it will vest. It will vest. You will ignore market linked performance condition. Okay. And finally, suppose it vests in 3 years. 5 years was your estimate. Estimate is greater. It vested in 3 years. Actual. So now when it vested in 3 years, what are you going to do? Sir, now you will apportion the EBE over actual, because now though the options have vested, now you have to give the shares to the employees. They will come and say, we touched 1,000 rupees share price, you give us the shares, we will exercise them right now, and you have to give it to them. So that is why you will spread over 3 years. So if actual is greater than estimate, spread EBE over estimate. If actual is less than estimate, spread it over actuals. Okay, but ignore the market conditions otherwise. Whether you meet it, whether you do not meet it, all those things will be meant to confuse you. You will have to record it because the market conditions are factored in the fair value calculations. Okay, let me look at 1 or 2 questions. Sir, whether problem number 9 part 2, which is problem number 9. 1 second. I need your did we do today problem? 1 second. Let me check. I got it. Okay. Question number 9. Srinidhi, you've asked the question which we did today, modifies the terms of the award to require only 3 years of service. So that is the question which you are asking, right? So that is this question. Okay. This is done. This is done. This is done. Vesting conditions. 1 second. Question 9. Calculation of EB. Yeah. So you are asking this one. Srinidhi has asked a question whether in this case we had done this question, which is question number 9, P Limited granted for 1 second. Let me try to search that question. One second, please. Study module ICAI, test your knowledge. Just I'm almost winding up the class. That is the last query that is there. So I'm almost winding up. ICAI, test your knowledge. Not this one. Illustration 9. Not this one also. I only lost track of my slides. RTP illustrations 19, test your knowledge. This is question 5, 6, 5. Illustration 8, 7. One second. I have lost it. Not very sure. Slide number 73. Thank you. Thank you for noting it. Yeah, this is the one. Okay. So now in this case, Srinidhi is asking whether this is a cancellation. This is not a cancellation. What P Limited has done is it has modified the terms of the award to require only 3 years. This was initially a 4-year option plan. Now it has come down to 3 years. So this is not a cancellation. They have not told cancel. They have told P Limited modifies the terms of the award. So this is a modification of not exercise price. This is accelerating the options. This is accelerations. But the same treatment applies for cancellation also. The same treatment applies for cancellation also. You have to give the same treatment. Okay. That means you will take the entire expense in the year of cancellation. Same treatment applies. Okay. Why? Because the employee is becoming free from the date of cancellation, and that has to be reflected. You cannot bind the employee in the books, right? You have to make him free. So you record all the EBE and close that whole option scheme. Okay. It's not cancellation, but the treatment is similar to cancellation. Okay. So with that, we conclude 102. Now, whatever questions are there, which I have discussed, these questions are all what you can say. I will share the solutions of all these questions. I'll share the handwritten notes also. I have prepared the solutions in Excel. I just need to, set the question number, slide number, synchronization correctly and get it done for you. I'll be uploading this by tomorrow or day after in the next 1 or 2 days. Okay, so I hope that you will respond, you will view that material which is uploaded for you. Okay, and with that, I conclude today's discussion. I'll wait for a couple of minutes for any query. I'll wait for a couple of minutes. I have extended by more than 1 hour. Okay, it is strictly not permissible, but still doesn't matter. Okay, thank you everyone. Okay, I think all the queries are addressed. There are no more queries, but you can always reach out to me. Okay, you can always, reach out to me. You have the institute's mail ID with you. You can always feel free. fr-final@ICAI.in. Okay, so this is the query sheet, the query email which you can mail to me, and I will surely respond to you. Okay, so please do the questions which I have discussed, only the theory. So you should be able to understand better. Okay, so thank you everyone. Have a stay safe and see you guys on 22nd March with leases. Okay, until then, stay safe everyone. Thank you. Thank you.